Well, I was 16 and sick of school. I didn't know what I wanted to do. I bought a guitar, I got the fever, that's rock and roll. I played at parties, played in bars. I spent my money buying new guitars. I scream my heart out, but I don't love it, that's rock and roll. Well, come on, everybody get down, get with it. Come on, everybody get down, get with it. Come on, everybody get down, that's rock and roll. It's when the smoking and the heat have got your heart pounding right with the beat. Don't try to fight it, just get excited, that's rock and roll. Now don't you worry about being a star. It doesn't matter who or what you are. Just get the rhythm and let it fill you. That's rock and roll. Well, come on, everybody get down, get with it. Come on, everybody get down, get with it. Come on, everybody get down. That's rock and roll. Well, come on, everybody get down, get with it. Come on, everybody get down, get with it. Come on, everybody get down, that's rock and roll. And if you feel it, clap your hands. Let's see some sweat for the boys in the band. Now let me hear ya, let me hear ya. That's rock and roll, everybody get down, get with it. Come on, everybody get down, get with it. Come on, everybody get down, that's rock and roll. Oh yeah, come on, everybody get down, get with it. Come on, everybody get down, get with it. Come on, everybody get down, that's rock and roll.
Day Trading Radio presents a Briguy trading production.
Good evening, everyone. This is Briguy with Briguy's Tools of the Trade. Hope everyone's doing good out there. We have an interesting show set up for you today, and as was mentioned in the announcements, this will be hopefully one in a series of shows we'll do over the few weeks. I don't have a set schedule, but just to say that we plan on covering options as a tool going forward on several shows, and we hope you're able to join us for those. So today we have with us a special guest that perhaps by now you already know who it is. You know her as a member of the site for a number of months now, and she's been very vocal in some of our sub-trading rooms like the options room, and recently even helped start our new trading only room. And I would say perhaps she needs no introduction, but I will introduce her anyway. Please welcome Dilafng. Di, welcome aboard.
Hello. Can
How
you
are
hear
you?
me?
I can hear you.
Excellent. Can everybody else hear me? I guess we'll know soon enough.
Yes, yes.
You said I was very vocal. That's a good thing, right?
I meant that in a good way. Absolutely.
Okay.
Absolutely.
Good, okay.
That's what comes from not having a lot of notes written down.
Oh,
I was telling you earlier. So welcome to the show. I don't.
Thanks.
I know we've talked before on other shows. I'm not quite sure if I remember you calling into this show.
I have not called into this show before, and this is a first.
Okay, well, we appreciate it, and I do like having some of our different members call in. It's appreciated, and I appreciate you taking the time. I know that we have the time difference. You're on the other coast, and so maybe this is going to keep you up past your dinner time. I hope we don't cut into that too much.
Nah, it's 5 o'clock only. I've got plenty of time.
All right, good.
Probably more in danger of keeping you up past your bedtime.
Well, we'll see how that goes. I hope you like the introductory song we played.
It was wonderful. I don't know that I've ever heard it before.
Seriously? Well,
Yeah,
I
it was
noticed.
fun.
I noticed
It was a fun
the chat room DJ did not post the name of the song. Did you recognize the song?
I don't think I did.
I did see one gong. Maybe I'll ask that out to the room before I reveal it. Does anybody know what the name of the song is that I just played at the intro? And now I got to scroll back and make sure I didn't actually post it because that would.
I didn't see it. Will there be prizes?
You know, I'm trying to work out some kind of a deal so I can have prizes like this. Maybe give away a T-shirt or something.
I don't see anybody guessing it yet.
Nobody's guessing. And some people are saying they didn't hear it, so that's you don't get to win. We just got an answer, but that could just be somebody repeating the chorus.
Yeah, make them tell us who it is.
Okay, I'll tell you what. I'll leave that out there as a question for the audience, and we'll see if someone along the way can chime in. And I'll save that little gem for another time. So, Dilafng. I mentioned that you had recently started or helped start. I don't know if it was just you or a collaborative effort, but recently we had the trading only room here at daytradingradio.com that was started up.
Yes.
How's that been working out?
I think it's been pretty good. I had a chat with a couple of my favorite traders, a couple of our very good stock traders. I think it was a week ago last Friday, and I had talked to each of them before separately, and they both expressed a little bit of frustration because they felt like the trades were getting buried in the main chat room, and it really came to a head just in the last 3 weeks before the election, because as you know, it got pretty crazy in there with all the discussion of who was going to win the election and whatnot.
Sure.
And so I got both of them into one chat room, and people have brought it up before about, hey, why don't we just have a chat room for just trades? And for whatever reason, people didn't like it. But, with these two guys and I in the chat room, we just decided, you know what, let's just try it and see if people like it. So I started it up and put together a blog post about it and explained what it was for and kicked it off, and it took a little while to get going. I think I've seen a few more people posting in it just this week. Last week it was a little slow. There were 2 or 3 people that were consistently posting their trades, and then there were other people who were posting chatty kind of stuff and more macroeconomic stuff, or things that were not specifically trade related. So I would of course give them the most polite of smackdowns that I could. And I think perhaps people were a little bit afraid to post last week, but they seem to be warming up, and so I think it's working well. We have typically, I think, around 30 or 40, maybe 50 people in that room during the day. So it's catching on, I think.
And out of that 30, 40, 50, how many would you say are active participants?
Oh gosh. Well, let's see. That first week it was about 3. This week maybe between 5 and 10, I would say.
Okay.
Yeah, I'm just guessing.
That's not bad.
But, yeah.
10% participation is very good. You probably got a lot of lurkers in there.
There are.
I know I've gone in there myself.
Yeah, that lurking is fine. That's where people go to learn. We have, how many people do we typically have in the main chat room during the day? Hundreds, right? Can you imagine if they were all posting?
Which I think was the point of the room, right? To help cut down on the number of posts that were coming through.
Yeah.
So I see some of the questions in the room, and Kumar, of course, is always looking to help out, willing to help out. How do you get into this room, this trading only room?
There are a couple of ways to do it. You can type pound trading only, and then enter that into the main room and click on that, and it'll take you into the room. Or you can go to the channel list, which you can find in the main chat room, different locations depending on which chat program you're using. If you're using Flash, it's in the lower left. There's a little box just to the left of that pretty little circle, the color wheel.
Mm-hmm.
And if you click on that and click list channels, it will list the trading only room. And I think if you're using, not HTML, Java.
Right.
There's a channel box at the top of the chat window that will list the channels for you. And there are enough people in there that it's open all the time. There are people logged in overnight. So that room will probably always be there if you check the channel list.
Right. In fact, I just realized that since I'm broadcasting live, maybe it would be a good idea to show where that box is. So it's in this lower left corner of and I'm using the Flash chat. So you just click that left box and then choose here list channels, and that will give you the whole list of all the rooms that you can go into. So in this case, trading only.
Right, and if you're listening and you're not a member, what's wrong with you? Come on.
Absolutely. How hard can it be, right?
2 weeks for free. Where can you go wrong? Sign up. Come in and say hello.
And Kumar, I don't know if that was directed at me, but I didn't mean to say that you were asking a question. I just meant to say that you were helping the other members there by giving the answer. A couple things to note about the chat rooms. When you go into the chat room, you're not going to be able to scroll back and see any history. So you might get in there and hear people in the middle of a conversation, and that's just going to be what it is. If you're that lost, you can ask somebody, but don't try to feel like there's a way to scroll back, and there's not a current way anyway to search through the history. Whatever they do on the server side as far as backups and whatnot, those are there, but these are not made readily available to the members to go back through and read through. Just to let everybody know. So this version I have here, this is the Flash version, and if you had the Java version, and I wonder if I can open the Java version without breaking anything. Let's see. Here's the Java chat, and you said there's a box at the top?
Yes.
All right, let's see if that comes up here.
And you said that you can't go back and look at the logs or the chat, but you can get to the chat logs for the last 2 days. Of
the main chat room. Yeah, I meant the trading only chat room.
Right, the main room and the futures room, of course.
All right, let's see. I just had the Java logo pop up, and here's the thing where some folks might get a little mixed up. You get this pop-up window security, and you got to be careful how you're reading this, because you're thinking, oh yeah, it's okay, and you hit yes, but you have to read the question. Block potentially unsafe components from being run, recommended. The answer to that is no. In this case, we know what we're doing. We're trying to run a Java application, and we don't want to block it. So if you said yes to that, you're going to end up in a loop, and you'll have to refresh your browser in order to get back in again. So I guess I haven't loaded it in a while, because it seems like it's taking a while for it to load, in which case, as RPM would say, why aren't you using the Flash version? And
I've heard him say, "Why are you using the HTML version?"
Or the HTML as well. I think the order is the Flash chat, the Flash Lite, the Java chat, HTML chat, and then there's the Skype version where you just call into the show and have somebody read it off to you the whole time. And there it is. See, now here's the funny thing, Di. I've been in this section before, and I never noticed the channels button up at the top. So I kind of wanted to do this so that I would learn something. So there's the channel rooms, and okay, I see what it's doing. Can I click these? Trading
Yep.
only.
You can.
Look at that. Learn something every day. And I see you've got a nice little topic here that it posts.
Yes.
So I suppose you get to change that if you wanted to. You can,
Yes.
not people coming into the room.
Yes, I could change that if I wanted to. If I wanted to make it rude and obnoxious, I could.
Uh-huh. All right, I better clear off Kumar's comments are getting broadcasted. The lovely gentleman from South Dakota. Right, Kumar? It wasn't South
Part
Dakota.
of South Dakota?
I don't know where he's from. I'm just saying that.
Okay.
All right, so that is the trading only room, and as I got to get used to calling you by their handle, Dilafng. As Dilafng mentioned.
Yeah, you can call me Dyla if you want, or
Dyla?
Diana, or
Okay.
Just don't call me Diane. We'll be fine.
All right, and I know Dianas that don't like to be called Diane.
Because it's not our name.
I guess so.
Yeah.
I'm, when you grow up with a name like Brian, there's not a whole lot of ways to short that one.
Not too many.
So, all right. So, I think we covered I remember there was something else I wanted to ask you, and that was, what made you get into trading options?
Well, I got fired from my
Ouch.
job. I got fired from my job of 20 years.
Okay.
I'm a geologist by schooling, and I'm an environmental consultant by School of Hard Knocks in the environmental consulting industry. So if you need a gas station remediated or something along those lines, a former rocket test facility assessed for risk assessment, that sort of thing, I'm your girl. But
Did you write reports?
what's that?
Did you reports? They're things that come in a binder, and
Oh, yeah.
there's multiple
Oh,
pages
yeah.
and tabs.
Oh yeah, lots of reports.
And
Lots of them.
was this in just one particular state you did all this work, or across the country?
I've done work in quite a few states, mostly in California, but yeah, I've been around.
And
Okay.
is there a state agency that you would be reporting to, or a federal agency?
Mostly state and local. It depends on the project. Some of the projects are, if it's a big Superfund site, then it's going to be Cal EPA, which is the Department of Toxic Substances Control, and I'm sure this is way more information than you want. If it's a gas station site that had a leaking underground storage tank, then it's going to be probably the county.
Mm-hmm.
So it depends on the project.
What if there's leaching?
Leaching. Are you talking about landfills or mines or what?
I'm talking about the underground storage tank leaching into the groundwater.
Oh, leaching. Leaching has a different sort of a definition. Underground storage tanks don't leach. They leak.
Oh, okay.
Yeah, they just leak. That would typically be a county oversight project.
Interesting. So now you said you got fired from this job after 20 years.
Yeah, I did.
Are you being literal about that?
Maybe I'm being a little bit free and loose with the definition there. My position was eliminated.
Oh, okay. That's like getting fired.
I was let go. So all of the 200 people that worked in my office, they decided that I was the least useful. And so they eliminated my position.
I see.
But thank God they did, because that brought me to you all, my lovely day trading radio family.
Aw.
Yeah, I love it here. You people rock. But I skipped over a few things there. After I got fired, I'm going to say fired because it feels better.
Okay.
I'm still a little bitter, but that's okay. After I got fired, I decided that I hated corporate America, and the company really was evil. They were abusing the employees, and there was nothing I could do about it, no matter how hard I tried. And I guess I wasn't enough of a company girl, but I didn't want to go back to that. And after you do,
You want to tell us the name of the company? We could all call in and trash them.
No. No, I won't do that.
All right, I'll go look you up on LinkedIn and find out.
Right, for whatever reason, so I'll pass on that. I'll tell you my former company though, because it's a good stock that I've just had pop today. But okay, let me back up.
Okay.
So I decided I didn't want to do that anymore, and after 20 years, you get tired of stuff. So I just tried to figure out what else I could do with myself besides that. And I've always been interested in investing and trading and mutual funds, and I always was very involved in my 401k and all that stuff. So I decided to give this a try, and I went to a Rich Dad education seminar, one of their free seminars that they do to suck you in and sell you another $500 seminar, which you go to, and then they suck you in to sell you another, a bunch of eight.
I think most of us have dealt with those kind of things.
Yeah, well, I being in the fragile state that I was, fragile meaning really not knowing where I was going to go with my life and really looking for a life jacket or a life preserver, I guess. I went ahead and grabbed onto that, what seemed like a life preserver, and I signed up for 8 classes with Rich Dad Education. And I took a couple of different classes. I actually took a class in e-commerce, and I also took one in foreclosures, thinking that real estate might be the way to go. Mm-hmm. Well, they have classes in just general business, and then they have a set of classes in securities, stocks, options, futures, forex, all that stuff, and then they have another set of classes for real estate. And so I took a few different classes and realized that real estate and I are not meant to be together for various reasons. I'm an introvert. I think to do real estate, you really need to be more of an extrovert, and so that really didn't fit my personality. So
that's very good that you noticed that.
Yeah. Yeah.
You can stop wasting time on spending more classes on something that you're not going to be good at.
Yeah, definitely. So I had a few classes left, so I took, the first introductory trading class, and since I knew I didn't want to do real estate, I just figured, okay, well, I'll just keep taking the trading classes, and the next thing that you learn after stocks is typically options. So, well, not necessarily. Actually, I could have gone the Forex direction or the futures direction, but I chose to go with the options. And so I've had, 3 classes, 4 classes.
Okay.
And that's how I got interested in options.
Now, are these classes in a classroom, or is this an online class?
They were both. Some of them were live and in person. Some of them were online.
Did you find one type of class to be easier to handle than another?
I preferred the in-person classes. It's nice to be able to see the instructor and ask them questions, without having to type them in. Plus, you get to meet people that way.
Right. And you still stay in touch with any of those folks?
Oh, no.
Okay.
Okay, I mentioned earlier that I'm an introvert.
Yes, I did hear that.
We're not good at that. I don't even call my parents. I don't keep in touch with any of those.
Oh, boy. Just have them tune into the show.
All of my friends are right here in this room.
Oh, my goodness. Di, I hope that's not completely true.
It's almost true.
Because I do have a fella from North Dakota who would like to come visit. No, just kidding.
Oh, okay.
I don't know where he's from, but he would like to visit.
Okay. Well, I have a huge house and plenty of space, so send him on over.
All right. I'm starting to smell a compound. Is this a hippie compound? Is that where you live?
Huh? Me? No.
No?
No.
All right.
It was just a big, old, historic house that was built in 1922 and has way too many plumbing problems. Which is why we're moving soon. So if you're going to visit soon.
All right. Well, is it on the market? Maybe somebody wants to buy it from you.
I wouldn't recommend anybody buy this house.
Okay, we appreciate the
Okay.
honesty. All right, so you took some classes in options,
Yes.
and now I've seen you in the options room now for a few months, and so I get the sense that you're comfortable with trading options. You've been doing these shows on Wednesdays with Joel, Trade for Pay, also about options. What is it about options that you've kind of gravitated towards spending more time and learning and understanding that, and then also trading options?
Wow, that's a good question because I've lost a lot of money trading options. You know, every once in a while I ask myself the same thing. Why are you, I'm hitting myself on the head. Why are you trading options? Why don't you just stick with stocks? It's safer. I don't know. It's the leverage, I guess, and it's the ability to risk small amounts if you trade only one contract, which is one thing that I keep telling everyone, please trade one contract. But it's easy to lose a lot of money. It's also easy to gain a lot of money. And you also have a lot more, I hate to use the word, but I can't think of another one, options. You have a lot more options with options. You
Flexibility.
know? Yeah, their flexibility. Thank you. There's so much flexibility with them. And you can do so many things with them that you can't do with stocks.
Right.
I just think, gosh, if I can get this wired, I'm going to be just fine. Of course, I've been practicing for 3 years.
Mm-hmm.
And I think I might be getting it finally.
Well, that's good. Don't give up.
Yes.
And for those in the room that have some questions, please remember to use either my name, or if you want to get Dila's attention and use her handle in the room, then that will draw our attention to it and we'll make sure we address the question. But you're right about options. I've been in the same boat, and I think from some of the days when I was just getting into it and I had some mentors that I was gravitating towards, and some that were friends before we even talked about trading, so it wasn't just about the trading. And there is this tendency to highlight the home runs when it comes to trading options. And I think it ends up putting it in your mind that that's what you need to seek out. But as I'm sure you've seen and other members have noticed, that sometimes just getting those singles is just fine. You can just do just fine with a few singles.
Absolutely.
The analogy is appropriate because 4 singles and you still have a run, and
Right.
you don't have to risk those outs, let's say, while you're trying to swing for the fences, as it were.
Right. I see somebody in the room commenting that you can't make any money with just one contract in the long term. I don't know how much. Yeah, you can make money. I disagree. I'm going to have to disagree a little bit with that, because
I'm going to disagree too.
Brian, like you just said, you do have to do the singles. And the other thing about just trading one contract is, until you demonstrate to yourself that you're really consistent, if you're trading more than one contract, you're just asking to blow your account up.
Right. And I think if you have any doubts about that, then come in the options room and talk to KJ Trader. And if in fact, what you could do is go back through the videos that we have in the members forum and look up KJ Trader's interviews, because time and again I've seen him placing trades with very little risk of capital. And later on, I'm going back and asking him and finding out that it's just one contract, maybe 2 in some cases, but sometimes just one contract. And because of his setups, because of his homework, and because of his patience, he's able to maximize his gains on that little bit of risk. So it is possible to do. Did I say the right trader, by the way? Was it KJ?
I think so. It's interesting that you mentioned him, though, because he also has times where he gets really frustrated, as I think all of us probably do, when things just, for whatever reason, all of your longs go short, all of your shorts go long, everything is just a mess. And I think it's KJ that is now doing a lot more covered calls because they're a lot safer than the stuff that he was doing.
Okay. And I've seen you posting covered calls as well. And I think we've talked about this before. It's an intriguing concept to me, and I feel like I need to wrap my head around a little bit more.
Okay.
And practice it before I get into it.
Yeah.
And you know, there's so many different ways of trading options that I would like to get into them over the course of time, and not, you know, I certainly don't want to cram all that into this show. And I also don't want to deviate into some of the preschool stuff that Joel's been focusing on either. But there are such a diverse amount of things that can be done with options. And I've been watching some webinars where they talk about butterflies and condors and broken wing butterflies and ways of, again, risking a small amount of capital and something called delta neutral trades.
Oh, yeah.
Where, you know, you could be putting, let's just say, $1,000 into a trade, and then over the course of a week making adjustments to that trade and usually I've seen this done with the SPY, SPY, Spider, and during the week making adjustments to that trade so that at some point it doesn't matter which way this goes by expiration, you've already locked in your gains. And I have to go back and watch it a few times to get my head wrapped around it, but it's fascinating.
Yeah, that's a pretty slick way to do things. I haven't tried that specific approach, but it can work really well. Well, you know, like anything, it can also not work sometimes. So,
Yep, it's true. and, you know,
I think that's foolproof. Unfortunately,
we should go on the record and say that we're not giving any kind of trading advice to anybody here. This is all about just education, just kind of sharing some experiences and some things that we know or that we've learned from others for your benefit. And it's really on you guys, the viewers or the listeners, to educate yourself on these things. And hopefully from what we share with you, it'll at least get you pointed in the right direction, instead of wasting a lot of time that I don't know if you agree, Dyla, of finding yourself wasting time looking in certain directions and finding out that there's better ways to do things.
Yeah.
So let's get to the theme of the show,
Okay.
which is the teaser that we put in the announcement, and that is avoiding the pattern day trading rule with options. Now, I'm going to learn something here because I hadn't considered this before you mentioned it, and I did try to poke around and look into it myself, and I found, to be honest with you, I found conflicting answers on this. So I've got an answer that I'm happy with from my broker, and I think if anybody as we go forward, if anybody has any doubts, then we'll just leave it to say, talk to your broker. And I don't want to get into an argument with anybody saying that it's this way or it's that way, because I did find conflicting answers.
Well, I'm curious what the conflicting answers were. Can you summarize?
In simply speaking, that the pattern day trading rule does apply to options, and I think as you're going to reveal the answer, it's going to be one of those "it depends" kind of a things.
Well, no, it doesn't depend. It does apply to options, as I understand it.
All right. So I don't mean to confuse things. Let's start with my first question to you, which is, what is the pattern day trading rule?
I'm glad you asked that, because that's what I was going to start with anyway. If you hadn't asked, I was going to go there.
Look at that. We're just kismet.
We are. It is. It's.
I don't know if that's the right way to put that, but anyway. You know what I'm saying. We're on the same page, so go ahead.
Exactly. So, we see this a lot, or I see this a lot in the chat room. We get new people in there all the time. What is this PDT business? So, and does it apply to stocks, options, Forex, futures? What's this about? So what it is about is a rule that was passed by the Securities and Exchange Commission that limits the number of day trades that a person can do if they have less than $25,000 in a margin account. Now, I'm going to actually just go ahead and read straight from the SEC's margin rules for day trading pamphlet, which you can find on the SEC website if you'd like. It says, FINRA rules define a pattern day trader as any customer who executes 4 or more day trades within 5 business days, provided that the number of day trades represents more than 6% of the customer's total trades in the margin account for that same 5 business day period. Let's see, it goes on. There's some other stuff in there I don't want to go over. And it says, okay, what is a day trade? FINRA rules define a day trade as the purchasing and selling or the selling and purchasing of the same security on the same day in a margin account. This definition encompasses any security, including options. Also, the selling short and purchasing to cover of the same security on the same day is considered a day trade. Anything that you hold overnight does not count. And then it goes into the minimum equity requirement. It says the minimum equity requirement for a customer who is designated as a pattern day trader is $25,000. This $25,000 requirement must be deposited into the customer's account prior to any day trading activities and must be maintained at all times. A customer cannot fulfill this $25,000 requirement by cross-guaranteeing separate accounts. Each day trading account is required to meet the $25,000 requirement independently using only the financial resources available in that account. Just a little bit more here. If a customer's account falls below the $25,000 requirement, the customer will not be permitted to day trade until the customer deposits cash or securities into the account to restore the account to the $25,000 minimum equity level. So what they're telling you is if you have $24,999.99 in your margin account, you can't make more than 4 day trades. Was it 3? No, you have a maximum of 4. 4 or more within 5 business days, and you're a pattern day trader. Now, I've had my account locked up because I accidentally made day trades that I didn't realize were day trades. And when you do that, you have to call your broker and grovel and promise them you'll never do it again, and they'll unlock it for you. But it can be pretty nerve-wracking, you know?
Sure.
You get all these new people, and they're, they have small accounts, and they're trying to learn this thing, and all of a sudden what if you want to scalp something? What if you've bought a stock and then all of a sudden it goes south on you and you want to get out, but you ran out of day trades? It's crazy. It is a risk because I think Johnny mentioned it earlier today. It can cause you to do things that you don't want to do. It can cause you to do things that are actually bad for you financially. So that's the rule. Did that all work for everybody?
Well, I seem to see a few conflicting comments of folks just saying, "Hey, just trade futures. You don't have to worry about it." But
that's true. You can trade futures or forex, but not everybody's comfortable with that.
Absolutely.
So, yeah. And the other thing too is if you have a cash account, the rule doesn't apply. It's just for margin accounts. If you're trading in a cash account, then your problem is going to be, number one, you can't borrow any money, so you can't leverage that money. Number two, you have to wait for your trades to settle before you can trade that money again. So that has its own separate frustrations.
And what are the settling timeframes?
Oh gosh, I think for stocks it's 3 days, and I'm not 100% certain on that. I think it's 3 days for stocks and 1 day for options. But
that's correct. Yes.
Okay.
You get a cookie.
I'm flying without a net here. Normally, whenever I've been on before, I've had Joel on the line, and he's my hero. Whenever I have an issue or a question, he can always answer it if I don't know or confirm that I'm right. So thank you for confirming that was correct.
Yes, absolutely. I try to help out. I have a question coming into us from Skype, and that is from a non-member. And I don't know, sometimes I feel like, why am I answering this guy's questions? But he's been a loyal follower of Johnny's for years, and so I can't fault him for that.
We love everybody here, that's why.
We do. So his question was which page you were reading this rule from on the SEC. I don't know the answer to that.
This is actually, it's not the it's not the law itself. This is, well, I'll read you the web address. It's www.sec.gov/investor/alerts/day trading.pdf. And I'm about to paste this into the room too. So if you sign up and become a member right now, 2 weeks for free, you can get in here and check the chat logs and find the link right there.
There you go.
But yeah, it's from a pamphlet. I don't know chapter and verse of the law, but that was directly from the SEC's pamphlet.
Yep. And I did paste a link earlier too. It was from the SEC's website, and it probably links to the same pamphlet that you just pulled up.
It probably does. The title is, it's called Margin Rules for Day Trading.
Okay. So let's just explore this a little bit more, just to cover the bases if some of our members are wondering about this. So the law was put into place back in 2001.
Right.
And it was done, believe it or not, to protect you as the trader from being too risky. And I think it really shows a disconnect between the SEC and trader and us, us as traders,
right?
Because they consider if you are buying and selling on a breakout, go through the logs today, the trade alerts from Johnny, and you'll see places where he bought something earlier in the day and sold it an hour or so later, and and he's got plus $2, plus 1.5, whatever it is. Those are considered to the SEC risky trades because he got in and he got out. I think that they're just really too focused on an investor standpoint, a long-term standpoint. And I read a blog where I thought some of the arguments were pretty good regarding the fact that they're limiting the liquidity that could be there from people that would be trading as a day trader but can't because of these rules.
Right.
And isn't that what helps the market when you have liquidity, when you have the price action moving around? And if it wants to move up, then let there be buyers and let them move it up. And if it wants to move down, let there be sellers that will move it down. But let the market dictate that and not more regulation.
Right, right. Yeah, I mean, you haven't even, excuse me, you haven't even touched on the fact that this is just one more instance of the government taking away our personal freedom. It's my money. I should be able to lose it if I want to.
True. And apparently you've done that.
I've been great at that. But, just because I don't have $25,000, don't tell me what I can do with my own money. But
right.
Okay, I won't start going down that road. But
and you mentioned it.
It's really taking away a lot of freedom for a lot of people.
Right. And you had mentioned it too, and this was mentioned in the blog, that according to the logic, if you have $24,999 in your account, then you're not very good with your money, and you're too risky. So you have to have one more dollar, and then you could be risky.
Yeah, one more dollar and you're all better.
I mean, that's a ridiculous logic.
Crazy, right? Well, I mean, they had to put the number they had to select a number somewhere, but it's just so arbitrary. Anyway, I don't know how they came up with the 25,000, but that's what it is.
So I put a graphic on the screen, which is from, coincidentally, I believe a broker that you have frequented, if I'm not tongue-tying myself. And what it's showing here is a demonstration of buying an equity on Monday and then selling it later that day, and then Tuesday buying a different equity and selling it later that day, and then Thursday is the example of buying an equity, selling it, and then Friday buying that same equity again and selling it. And the fact that you've done 4 trades within 5 days, your account will be flagged as a pattern day trader. Now, what happens once your account is flagged as a pattern day trader? Now, you mentioned groveling.
Yes. They'll freeze your account. They won't let you trade until you increase the equity in that account up to $25,000.
That's right. So let's say you have $2,000 in your account. There's plenty of margin accounts out there that will let you open an account with $2,000, and they'll give you perhaps, let's say, 4-to-1 buying power. Maybe it's 2-to-1. Whatever works. There's prop traders out there who'll give you way more than that. But now you get flagged. So your solution then, number one solution, is to deposit $23,000 to bring your account up to the 25 requirement. What's a second thing that could be done with your account?
Dang it, you caught me off guard.
There's a time frame that you can wait.
180 days, right?
90 days.
90 days.
90
okay.
days. So you could, in reality, you could leave that account alone for 90 days and go trade another account with another broker.
Yeah.
I don't know how comfortable that would be to do, but that's just throwing that out there. That's an idea. And I believe you're just not allowed to trade that account. It doesn't mean you can't use that money and move it to another, keep the minimum required to keep the account open and move that money to another account with another broker. And many of us have multiple accounts anyway with different brokers, so that would just be another way to work around that rule. But here's something that I wanted to mention as well. Let's say you do have $25,000, and so you start trading, and you do 4 trades in your first day. And now, just because you put the money in there doesn't mean anything. Once you've traded those 4 trades within 5 days, now your account gets flagged, and you're a pattern day trader. Now, let's say a couple days later, your account drops below $25,000. Your account is still flagged as a pattern day trader.
Right.
So you're going to run into that same problem. You can't just suddenly decide, well, you know what, I'm not going to trade day trades. I'm going to let it drop below 25. Let's say it's 20,000 because you needed 5 to do something. So you have 20 in the account, and then you could just say to yourself, oh, as long as I don't day trade anymore until I bring up that 5 again, I'm okay. Well, unfortunately, that's not the case. Your account's already been flagged. So you would have to do what you described earlier, which is go to your broker and get them to remove that flag from the account. And the one broker that I've talked to made it seem like that was a once-in-a-lifetime event. I don't know how true that is.
I don't know. My broker is IB, and they said that they could do it again, but it would be another 180 days if I was naughty a second time.
Right. So, what about with options now? You're saying that you can avoid the pattern day trading rule with options. How can you do that?
I'll get to that in a second, but let me back up because
Okay.
I have people pointing things out in the room that they're absolutely true, and I apologize, Brian. I've been trying to read with one eye and listen with one ear, and things get a little bit cross-wired, but I said earlier that they freeze your account. That's not actually true. You can't open new trades, but you can close any trades that you do have open. So
Right.
if you're flagged, and you might have said that already. Like I said, I was reading.
Nope, didn't
and then
say that.
someone
You're
else
good.
in here is saying that the first time you're naughty, they flag your account for 90 days, and the second time it's for 180 days. I think I might be getting that right. Uh-oh is in the room. I haven't seen him in a really long time.
Uh-huh.
But he knows what he's talking about. So he's the one feeding me this information, and I'm grateful as ever.
So is he talking about the lockup period that I mentioned? That first it would be locked for 90 days. You couldn't open new positions for 90 days. And then the second time it happens, it would be 180 days?
180 days. We should just have him call in. Hey, do you want to call in?
Yeah, absolutely. Call in.
The first is 90, the second is 180. But since he's showing his face, I got to tell you, this guy, he's taught me so many things. I hope it's okay if I say he's the one that taught me all this stuff. He's really, really smart. And I haven't seen him in the room in a while. I wasn't even sure he was still a member, but big shout out. Awesome to see you. So, how to avoid the pattern day trading rule. There are a few ways to do it. You know, I was just having a chat with someone yesterday who he sent me a private message and he said, hey, I'm long 300 shares of CSX. I've used 2 of my day trades. I have 1 left. I've got all these positions open. What should I do? Should I sell it or hold it for another day? And I looked at the chart and I thought, well, you know what? If it was mine, I'd sell it. But he was worried about using his day trade. And so I asked him, well, do you trade options? And he said, no, he didn't trade options. And that was too bad because there's a real simple solution. If you're long some shares and you want to take gains, but you don't want to sell the shares, sell a call. Sell a deep in the money call. If you're sitting on 300 shares of CSX and it's gone up $3, go find a call that is deep in the money, somewhere below support, and sell the call. You've locked in your gain, and the next day you can either close both of those positions out, or you can wait for the shares to be called away if it's not too far off and you don't mind sitting on them. So I don't know how much detail you want to go into, but that's just one example of how you can avoid a day trade. You know, if you...
I think you gave the answer, so we could just end the show right now. No, if you had any examples, we can show that on the screen, or I could put Notepad on the screen. We could just type out the explanation, give people some numbers to work with, or however way you want to give a second example, however way you want to do it.
Let's see. I was looking at, let's look at the CSX. Let's go ahead and pull that one up, because that's the one I was looking at with him yesterday.
Okay. You want this as a chart?
Sure. We'll look at the chart first.
All right. So let me bring over...
Uh-oh. Of course I listened. I listened to every word repeatedly, and I read them over and over. I learned something. I'm telling you, this guy's amazing. Yeah, everything I know, everything you're hearing is not from this brain, I'll tell you. Came from another much smarter than I.
All right, so you said CSX?
CSX, yeah, and he bought it at 1928. And this was yesterday we had this conversation.
All right. I have these open, high, low, close studies that I think are getting a little too busy on the screen, so let me just take them off.
Okay.
And and I thought I had... Let me see if I had the right... Now that's the 5 and 15. I'm sure we'd like to have the 20 and the 50 that we're used to looking at. There it is. All right, so would you prefer a 60-minute or a daily or?
Let's look at the daily first.
Okay. So give my computer a second to catch up. I clicked too many things. All right, so there's our daily.
I see someone in the room saying, you should never be exiting a trade because of a day trading rule. Well-planned trades never have this situation. Just follow the rules. I'm not entirely clear on exactly what that means, but I think we all run into situations, even if a trade is well planned. You know, maybe you get into a trade thinking it's going to go up and it rolls over and it starts to go down and horrible things are about to happen and you think there's going to be a waterfall. Well, sell a call that's $20 in the money and don't use your day trade. You know, you're getting out. You can even, I mean, you can lock in a gain doing this. You can also lock in a loss and not have to get out of something by selling really deep in the money call.
Mm-hmm.
So he purchased CSX at 1928, and he bought it yesterday morning. And the stock had gone up, as you can see that nice green candle there. It's a pretty tall candle. And I was looking at it, and I was looking at the lower time frames thinking, wow, looking at the volume and looking at the indicators and thinking, you know, if this were me, I'd get out. And so he did end up selling. I told him, well, you could sell a call and lock in the gains. And he said, oh, no, I'm scared.
Okay.
He wasn't even sure if he had approval in his broker to sell options. So he just went ahead and sold it. But he used a day trade, and he really didn't have to. So he bought it 1928, and he ended up selling it 1964. And as you can see, it did go down today. So I think he did the right thing, even though he had to use one of his day trades. But I looked at this when I was chatting with him, and as an alternative to selling his 300 shares, he could have sold the December 1750 call, and maybe now's a good time to go to the option chain and let's see what it's going for today. He could have sold the December 1750 call for $2.15. So we'll see where it is now. Now, if he had done that, then his price per share would have been what he paid, which was $19.28, minus what he got per contract share for the call, which was $2.15. His cost basis, if you will, would have been $17.13. Now, which call did I tell him to sell? $17.50. So if he had sold the $17.50 call and his cost basis was $17.13, he would have locked in a gain of 37 cents per share. Now, I don't know if that's all making sense to everyone, just hearing it, you know, and not seeing it written down somewhere. But essentially, if he sold the call, assuming that stock stayed above 17.50, come December, he could have done two things. The first thing he could have done would be to wait until December, and that call, assuming the stock's above 17.50, the stock would have been called away for 17.50, and he would have made 37 cents per share. The other thing that he could have done was he could have gone back today, and since he purchased the shares and the option yesterday, he could exit either one of those trades and not have it count as a day trade. So he could go back today and purchase that call back. Now, since the stock went down today, the price that he would pay to buy that call back would have been less, and I don't know what it is. I can't see it right now. But he would have made money on that call that he sold, and he would still be holding the stock. That would just be one way that he could do it. Am I completely losing everybody? I hope not.
Let's assume you're not.
Okay.
So I'm just going to spell this out here. Why don't we just take a look at the math?
Okay.
And I think I like this example.
That's great.
So you gave me the numbers. He bought it at 1928, sold it at 1964.
Right.
And so I'm figuring that actually is a 36-cent profit.
Right.
So that would be times 300 shares. So that's $1.08. No, that can't be right. It's got to be 108. Should be $108, right? Right,
yes.
108. Okay. So now the using options, we say that you own the 300 shares.
Yep.
At 1928.
Correct.
And then you're going to sell the December 17.5 call at we said 215.
215, and he could have sold one even deeper in the money. If you really want to make sure that you're covered, sell deeper in the money.
Right.
Go all the way to the bottom if you want.
Now, in this example, there's actually no open interest down there. Of course, he's selling, so you'd have to get somebody that's willing to buy it. But
yeah, the bid-ask spreads are always going to be an issue. That's something
Sure.
you want to look at. This isn't always going to work with every single stock. But yeah, go ahead. Sorry.
no, that's fine. So let's just, for argument's sake, say that he did three of them. Okay.
Yep.
So this means, and we're not going to get completely into a bunch of lessons here on trading. There's plenty of other classes that we've had and programs. You guys can check that out. So let's assume you understand the basics here. So three options, not to say I understand the basics, but three options at $2.15 each is $645. And I'm going to put parentheses around this because this is a credit that he would take in. Right?
Yep.
And you mentioned that his average would now be
His cost basis, yeah.
cost basis.
Cost basis per share is going to be what he paid for the stock, 1928, minus the price per share, per contract share that he got for the calls. So that was 1713.
1713 per share.
Right.
So if and this is for protection. So if the CSX, of course you picked one that can speak properly here.
I did that on purpose.
Yeah, thanks.
Just to see if I could get you to make a funny blooper.
Yeah, plenty of those. So if we go back to the daily, really you got to go back quite a bit. In fact, this is a yearly chart and it prints the bubble here telling me that this is a 52-week low on the 16th, which was Friday. So the question being whether this continues to break down, you still have another $1.50 before you get to 17.5. So as long as this holds up above 17.5, then very likely this option will expire and it won't be called away, and he would keep that credit. Is that the way I'm understanding it?
If the stock stays above 1750, then whoever bought the call is going to want to buy that stock and sell it into the market.
Okay.
They're going to call it away.
They will call it away at expiration.
50. Yeah, they will call it away, which is what you want.
Okay.
If you're going to hold it to expiration.
Okay.
Because basically you're locking in your gains. That's what you're doing. Instead of using a day trade, you're locking in your gains using the short call.
All right. So this isn't about another tactic that I was thinking about. So I'm going to write into the screen here now the amount of money that he's let out with the 300 shares, and maybe the cost basis is just the way to deal with it. So 1713 a share. Now what's the next step here that we would show of why this is a useful trade?
Well, if you want to assume that it goes to expiration and it gets called away, then you would want to enter 300 shares times 1750. See, we have to figure out. And let me gather my thoughts here. Just a second.
Okay.
If it gets called away at 1750, this is probably the easiest way to think about it. If it gets called away at 1750, and your cost basis is 1713, your gain is 37 cents a share. That's 1750 minus 1713.
That's kind of where I wanted to head with this. Okay. So if I've got this written on the screen properly.
That looks correct, yes.
Okay. So the scenario we're giving is on the 19th, this person bought 300 shares of CSX. And instead of triggering a day trade, closing the position and locking in 36 cents, he could have purchased 3 contracts
Sold.
or sold rather, 3 contracts, the December 17.5 calls. These would be considered covered calls, if you've heard
Right.
that term before,
Right.
because he owns the shares. And so in most cases, you could easily be approved to sell covered calls from your broker. What would that be considered, level 2 or 3?
Gosh, where's Joel? I don't know what the levels are.
Okay.
I'm
I'll have
not
to
sure.
get into that part of it. It's not a naked call, so don't think just because you're selling it means it's a naked call and there's unlimited risk. That's not it at all. You've locked in your risk by doing it as a covered call. So you're only getting 3 of them. You're not selling 10 of them and then exposing yourself. You're selling 3 of them. And by doing that, you reduced your cost basis, as Dyla said, to $17.13. And if it does get called away, in other words, if the stock then stays above $17.50 by expiration, then it would get called away, and your broker handles all this for you. You don't have to worry about finding out who's calling it away, and you got to send him the 300. And none of that happens. You just tell your broker that it's all good. They probably just tell you that they're doing it. They don't even ask
Yeah.
you.
Well, you'll wake up on Monday and check your account, and your shares will be gone,
Right.
and you'll have some money.
And you'll
which
have
is
some money.
nice.
So you'll be locking in then, instead of $108, in this case, you'd be locking in an extra penny a share. So what's that? Another $30 or $3?
Yeah, obviously your commissions are going to be a little higher. For some people, they pay more for an option trade than for a stock trade. So that has to be taken into account.
Right.
If you really want to avoid the day trade.
And we can even say that you'd also be locking up your equity here, because you've got $5,700 in this trade, that you would be locked up in the trade until expiration date.
You're not locked, though.
You're not locked. Oh, go ahead. Correct me on this.
If you let it go to expiration, you can let it go to expiration if you want, but you don't have to. The day trading rules are only for entering and exiting a trade on the same day. So I see J-Dub in here. Just to be clear, why selling that call does not count as one of your day trades? It's a different security. The purchase of the stock is one trade entry, and the selling of the call is another trade entry. You're not closing any trades, so those are different securities. Now, if he wanted to, he could have come back today and closed both of these trades. Since it's been overnight now, neither one of those would count as a day trade. So if we could, let's go back and look at the option chain and just see how much that option was today. Looks like 204. So 202 is the mid on the price of that December 17.50 call. So when he woke up this morning and saw that his stock was a little bit lower than where he might have wanted to sell it yesterday, he has a couple of choices. He could buy to close that call for $2.02 per share. And let's see, he sold the call for $2.15. He can buy to close it for $2.02. So if he wants to sell the call, he can make 13 cents on the call, right? $2.15 minus the $2.02.
Okay.
That would be something that he could do if he wanted.
So that would be 13 cents.
Right. So
Times 3 times 100. Sorry, go ahead.
Yeah, $39.
Okay.
Yeah, and I got to tell you, man, I could never, ever do this before I was with Interactive Brokers. Their commissions are so low. I made so many trades today. I mean, I don't even want to tell you because somebody's listening who might get after me. But, you can do these option trades for less than $1. Most of them are less than $1. So he could have just, he locked in $39 right there, and he still has his shares if he wants. Now, he could sell the shares right now if he wanted, or if he thinks the chart looks good and he thinks they're going to go back up, he can let them run some more.
Mm-hmm.
So it's up to him. He can exit these trades the next day and not have it count as a day trade.
Well, that's just completely brilliant, Dyla.
I'm telling you, I got this from someone else who's completely brilliant.
That is very brilliant. So basically, the whole point of this was that the fellow wanted to avoid the day trading rule. It wasn't that he wanted to exit the position.
Well, no, he wanted to know whether I thought he should exit or not. I said, yeah, I thought I would. But
Okay.
he was worried that he was going to be using a day trade to do it. He ended up exiting, but he could have done it this way and not used a day trade.
Well, let me think this through now. Let's say the stock went down to, all right, let's assume he's looking at it when it was 1964. And let's say the stock goes down to 19. What would the option have likely gone down to?
Well, we can look at the delta to figure that out. So if you go back to the option chain, if the stock went down 64 cents and the delta on that option, I didn't write it down yesterday, but look at that, it's 1.0. So for every dollar that stock goes down, the call is going to go down $1. Is that right?
Seems that way.
Okay.
So it went down 64 cents.
I get a little confused sometimes when I'm, talking out loud. I get confused sometimes when I'm not talking. So if the stock went down to 19, then that call option would have gone down 64 cents. And so the call would have been 215 minus the 64, which is $1.51, assuming I punched the buttons correctly. So yeah, if the stock went down to 19, he could go back and buy that call today for $1.51 instead of 202 and make some money that way.
So he would be even making more money on that side of things.
He'd be making more money on the short call, yes.
Okay. So either way. All right. So you know what? Instead of me trying to wrap my head around it completely, I love this kind of thing. I really do. This is very creative. This is one of the reasons why I like options, because of this kind of flexibility. And again, I appreciate what some of the traders are saying in the room, and I'm not reading every one of them word for word, but I did see some comments about the risk nature and how you enter your trades and exit and all that, and I appreciate all that. And of course, if you are just starting out, then you do need to take that into account. But if someone is just, they have an account and all they have is 3 or 4 grand, and maybe they're getting a 2-to-1 leverage, so they can get in and out of some positions, and maybe they're careful not to do day trades. Maybe they close their positions every night, and they'll do 2 day trades in a week, and then they go off to their day job. Whatever it is, everyone's got a different situation. It's nice to know that if you do get stuck in a situation like this, where you're not happy with the levels, that you can explore alternative choices with options.
Yep, absolutely. And, we all get into trades that we need to exit before we thought we would have to, and this is one way to do that. This is another way if you want to. Sometimes Johnny will put a trade in the box, and it's a scalp. There may be people out there thinking, well, I can't do this because, I've already used 2 day trades. I don't want to use a day trade on a scalp. But dang it, some of Johnny's scalps are the best trades that he does, and you hate to miss out. So, just go ahead and buy 100 shares if that fits in with your risk management. I mean, you don't want to buy 100 shares of Apple if that's what he's trying to scalp. But if it's something that you would be buying 100 shares of anyway, buy it in 100, buy 100 shares, and then when Johnny exits, go in and sell a really deep in the money call and take your money home, and you can exit both trades the next day.
Very good. I like it. Somebody asked a question there. Is that related to what we're talking about?
With your trades today, were they just options? Could you give us an example? I have been doing a lot of vertical spreads. And what I like to do is buy a call or a put And then when the stock moves in my direction, I'll sell a call or a put to lock in my gains that way. And maybe that's a whole different call, but that's another thing that my beloved mentor taught me, and it's been working pretty well. So thank you. Big kisses. Love you. You're fabulous. Cannot thank you enough. So I guess I could go over those, but
well, let me just mention one thing. Let me just mention one thing here before we leave it, and that is that in this first example, we're talking about selling deep in the money calls, and in the true sense of the term, for this example, a 17.5 would not really be considered deep in the money.
No, I mean, that was just kind of the first one that came to mind when he was first asking me. He could have sold the 15. He could have sold the 12.50.
Right.
Yeah.
So, and obviously that's when liquidity gets into things. I think when I had this on another version here, let me see. Is it the high-low? No. I'm trying to think. Oh, yeah, volume open interest. So here in this example, there's no volume down at the 15 level. So you might have offered to sell at that level, and then you're sitting there picking your nose waiting for somebody to hit it, and it's not working.
Right.
So, you know,
all those things come into play. You're going to want to look at the bid-ask spread. It's going to totally depend on the stock. You know, maybe Johnny's scalping a stock and it's not that liquid, and you know, this is something that you want to look at before you get into a trade. You know, if I get into this trade, will I be able to use this strategy to avoid a day trade to lock in any gains? So yeah, you'll want to look at the liquidity, the bid-ask spread on the options. If you can do it on a stock that has weekly options, so much the better.
Interesting. All right, so I've marked that down. That's one example of avoiding the PDR rules, pattern day trading rules. You said PDT. Is that how?
Pattern day trade. PDT. Pattern day trading.
PDT. I put PDR. I don't know why, but
yes, it's PDT
rule. All right. So, what's another example? I'm assuming you have other examples.
The most obvious other example would be a short. This works perfectly well on shorts too. If you go and sell a stock short and it tanks and you want to lock that in, but you don't want to use a day trade, you can sell a put, a deep in the money put, and it's just the same thing but upside down. So it works there too. Okay.
So do you have an example on that side?
Let's see. How about oh gosh, I was looking at one earlier. Yes, OXY.
Okay, Occidental Petroleum.
Yes.
And looks like a similar chart to what we had with the other. In fact, most charts look like this right now, the way it got beat up last week. So in this example, go ahead. You want to give me the numbers, and I'll plug it into the notepad here?
I was looking at this today, and I was assuming that we would sell it at 74.79. And well, we'll get there in a second. The thing is, by the time I started looking at this, well, that was at 11.50. So I don't know if the stock actually went down after 11.50 or not.
Is that unreal time or real time?
Real time.
Okay. You're not yelling at me. That's good.
Huh?
I said
would I be yelling at you or somebody else?
Yeah. Well, because I said real time versus unreal time.
Oh.
Because you don't know what unreal time is.
I have no idea what you're talking about right now.
I'm talking about Eastern time. Is it Eastern time, 11:50?
Oh, real time. Oh, that's what you meant. No.
No.
No, that's Pacific, silly.
That's more math I have to do.
I apologize.
So 74.79. So then late in the day is what we're talking about.
Yes, an hour and a half before the close.
11 plus 3 is 14. 14.50. What do you mean an hour and a half before the close?
Oh, 11. I'm sorry, I was thinking 11:30. Never mind. An hour and 10 minutes. I'm a little fuzzy too.
No, that's all right.
I've been drinking heavily.
14.50. It seems like it's right before the close.
11:50. Well, no, it's an hour and 10 minutes.
2:50. What am I doing wrong? All right, so 2:50 Eastern, and that would be somewhere in here when it's trading at about 74.65 or so, and
it proceeded to go up. So this example might not work so well, but we could play around.
What's wrong with it? You know, not all the trades work out.
Yeah, we could play around with it based on the delta, though.
So you're saying you wanted to short this stock?
So I wanted to short it.
So can we enter it at short at 75?
Sure.
Happens a little bit later in the day, but
yeah.
So I'm gonna write this down as 14 minus 3 is 11.15. Did my thing change clocks or something? That's right, isn't it?
What was the question?
What time of day I'm at? I'm looking at 14:15 Eastern, so that's 2:15.
I have no idea what you're doing. Let me pull up my chart.
All right, I'm sorry.
No, it's okay.
You know what it is? I'm just looking at it now. My clock is stopping at 1500.
Huh.
That's why it doesn't look right. Instead of 1600. I don't know if the futures thing screwed everything up or what's going on. That's why it didn't make sense to me, because I thought there'd be another couple of candles left here to go. All right, my computer clock is accurate. Let me just look in my platform. And
Kumar is offering to come on the radio.
And this is 2100 right now, and that's the right time. So I don't know why the platform has gotten a little wacky here with the overnights, but okay. So Kumar is welcome to come on if you'd like to do that. I appreciate that. He's got my number.
He probably just wants to give me a hard time.
I'm sure that's what he wants.
So
And
we're going to say that we sold it short at $75 around 3:30.
Now we're back to Eastern. You're just messing with my head.
3:30 Eastern.
Great. We love you, Kumar. All right, so now I'm thinking that we want to look at the value of the options at that point in time.
Yeah, well,
because I have a way I can do that.
If we're talking about getting out after a drop, then we would want to look at the options as they're priced after the stock falls. And it did come down a little bit. So yeah, let's assume that we saw it drop to 74, 77, and we wanted to get out, but we couldn't get out because we didn't have any day trades left. So instead of buying to cover the shares, we want to sell a put.
Okay.
So again, we want to go deep in the money.
Are we looking at weeklies this time?
Yeah, let's look as soon as possible.
Okay, so we got the November weeklies that expire in 3 days.
3 days, yeah. Now, let's see, the bid-ask spread is, it's not too awful on the 80. Let's do the math and see how much money we can make if we sell the 80.
All right, and let me just look at the this quick chart feature. I believe I can look at this and see what it was trading at near the end of the day. Oh, you know what? There's no volume in it, so it didn't even trade. And I don't have a way to look at the time and sales. Well, not time and sales, the level 2s at that time, since nothing executed. So anyway, you asked me to do what now?
Oh, I was just going to try and figure out how much money we would lock in if we sold the $80 put.
All right. So let's call that 515. Is that what you said?
Sure.
Okay.
So it's funny. I was looking at this earlier, and the 80 put was at 522. I'm trying to think if that makes sense. But the stock was lower. Okay. Anyway, so 515. So if we sell the put at 515 per contract share, and we shorted the stock at 75, then our cost, or it's not our cost basis, it's our credit basis, right? Our credit basis is 75 plus 515. So our credit basis is $80.15. In this case, it doesn't work. We'd be losing money if we did it that way.
Okay.
Because ideally what would happen would be you would get, say, 525 for that put. If we were able to get 525 for that put, then our credit basis would be 80.25. No, I'm thinking about this wrong. Help!
Okay, let's say $5.
I'm doing wrong. What am I doing wrong? See, I should have gone through this before.
No, that's fine. While you're doing that, I'm going to see if I can build the trade on the simulator.
Okay.
And we're talking about we'd be buying the put, right?
Wait, am I? See, I've been doing this for 3 years, Bri, and I still get confused. I'm telling you, I don't know why I trade options. I think I should just switch to stocks or futures.
No, that's
No.
okay.
Our credit basis. No, actually, it works with the 515 because we got 80.15 for it. And what's going to happen on expiration, if we let it go to expiration, is since we sold a deep in the money put, as long as the stock is below $80, someone's going to be thrilled to put it to us for $80. So they're going to put it to us for $80, and as soon as they put it to us, then our short 100 shares is covered. So we end up making 15 cents a share. Am I making sense?
That's how I look at it.
Good. See, you could do this much better than I.
I don't know why it works that way, but that's that's how I'm looking at it.
I have a hard time. I have to stand on my head to do these.
I've got these cute little risk profiles that I'm still trying to wrap my head around when you start combining things.
Yeah.
And if we just look at the breakdown that you gave, and we're talking about being short 100 shares at $75.
Right.
And then purchasing a put.
No, selling.
Okay,
selling
maybe
put.
this is why it's not working, right? Okay, so now we're selling a put.
Yep.
For for $5.
515.
Pay attention,
What
Brian.
was that? That's
$5.15.
close to the mid.
Okay, so according to the chart here, if the stock closes at $80 and where does it become zero? Oh, it's not zero. It's like right at the 15 mark. So let me see. $79.98 it looks like. This chart is approximate. So let's call it 80. So if it closes at 80 or below, then we've locked in $15, it looks like.
Correct.
And we shorted the stock anyway, and that's what we wanted to happen, was for it to drop. Correct?
Right.
But for some reason, we're thinking at late in the day there, after we've gone short, that there's a potential for a pop, and that's why we've bought the put or sold the put?
Right. Or, it reached our target. Maybe it went down $1 and we're happy with that, thrilled, and we just want to lock those gains in without using a day trade.
Okay. Now, in this example, it's showing a potential for unlimited losses. So are you sure that we're selling the put?
Unlimited losses?
Yeah, because this green line, which is the value, our P&L at expiration, it shows, for example, if it goes to $90, we're going to be out $1,000.
Yes.
Am I not adding the 7,500 we put into the trade? Maybe that's what I'm not doing.
Yeah,
right.
if the stock goes above 80, that would be a problem.
So how is this not a naked put? Since you have unlimited, what seems like unlimited losses.
Joel.
Am I asking too many hard questions?
Maybe, I got to be honest with you. I haven't actually done this.
Okay.
I have not actually shorted a stock and sold a put.
Okay.
If the stock goes up, yes, you are in trouble.
Well, I think it was Michael Freeman.
Again, that's why you're going so deep in the money. The deeper in the money, the better, because it's going to keep you safe. I mean, you want to go as deep in the money as you can without losing money because of the bid-ask spread or something crazy like that.
Okay.
Yeah, what you want to use a liquid stock. Ideally, it's one that would have weekly options. And your choices again here are the same. You can wait for expiration, or you can close both of these trades the next day and take your money and run.
Agreed. And in fact, that's one lesson that I appreciate someone sharing with me early on, because when I was first considering options, I think the fear factor is this idea about being put the stock or having the stock called away. And even if you're not selling naked on either side and you're just buying calls, the other side of it is worried that you're going to have to buy on expiration. You're going to have to go out and buy 1,000 shares of something because you went and bought 10 contracts. But what I appreciate is that the reminder that you don't need to hold it until expiration. In fact,
right.
I don't even like to get caught up in all the nuances of what might happen if you did hold it until expiration, and just simply tell people, don't hold it till expiration. Sell it before.
Yeah, close it the next day. Yeah.
Yeah. I mean, if it gets down to it, do it at noon on Friday of expiration and be out of the position, and then you don't have to sweat it anymore. So I don't know what happened.
I'm exhausted now.
Oh, boy,
that was more thinking that I was anticipating having to do. But
there's an old what's his name, Chevy Chase routine on Saturday Night Live first season when he's doing a debate as Gerald Ford, and he gets asked this very deep question with all of these references to numbers, and his answer is, "It was my understanding that there would be no math."
Oh, right.
And that's just how I always feel when you get into so many different scenarios
I'm feeling
here.
It, man. I hate this math. No, it's funny. Bri, I don't know how long have you been trading options, Bri?
I want to say probably 3 or 4 years.
Yeah. Do you still have to stop and think about it?
I do. In fact, I was just thinking of something on the way over here from where I was. This doesn't mean anything. When I was driving home, let's put it that way. When I was driving home, I was thinking about volatility and realizing that I don't even feel like I've completely wrapped my head around volatility.
Yeah.
I know what it is, but I don't exactly know how to look at a stock and know that there's too much volatility or too little volatility to make the premium of the option worth buying or not buying.
Yeah.
And I almost feel like that's a first grade lesson. And how am I trading this long? And I think it's when I end up buying and getting into positions and getting out of them is why I'm so hit and miss. Either I bought it too late or I'm selling it too early, kind of a thing.
Yeah.
And
yeah, this stuff it's all complicated, and I've been doing it 3 years now, and every once in a while I have to stop and think about something, and I'm thinking, gee, shouldn't I know this by now? Shouldn't this be second nature? Well, maybe not. I don't know. I'm not the sharpest knife in the chandelier, so maybe it's just me, but yeah, these things, they take some getting used to. Now, if I could, somebody in the room just pointed out, it was Goodbyes, I think it was. Goodbyes is awesome, too. I love this person. He pointed out that if you're selling an option that is in the money, you can be assigned anytime, and that is absolutely true. That's definitely a danger that you want to make sure that you're aware of. And there are a couple of other things, too. Let's see, we already talked about bid-ask spreads. Oh, the other thing, if you're going to do this, is ideally you'll have some very low commissions. Because if you're going to be buying and selling, you're doing 2 round trips if you're going to sell a call or sell a put one day and then close both the call or the put and the stock the next day. So you're doubling up on your commissions, and you need to make sure that that's not going to eat too much into your profit.
all right, well, you know what? We're got a little caller calling in, and Dyla, I don't mean to keep you because we did talk about how long this would be running, but I had Kumar call in here, and I believe I've conferenced him in, and he was bringing up in the room about volatility, saying it would be easy to figure on volatility. And just hold on a second, Eric. Kumar, are you still here?
Yeah, I'm here.
Okay.
Can you hear me?
How are you doing?
Oh, I'm doing all right.
I appreciate you following along, and I also had another member call in, and I just can't seem to hang up on Eric. So I appreciate you calling Epik as well. But if we could just hear from Kumar for a second, you said that there's an easy way to figure out the volatility.
Well, actually, when I said earlier that I wanted to get on, I had something to say about this day trading business.
Okay, so goodbye to Kumar. We're going to hang up. No, I'm just kidding.
Okay.
No, go ahead, please.
No, because Di was saying whatever she was saying, but I thought there was another aspect to it. But anyway, first to volatility, I just have a simple way of looking at it. I mean, there is basically the implied volatility, current volatility, and 10-day or 20-day historic volatility, which you can have to figure around where it is. But typically what I do is I look at on the option chain what the current mean volatility is, bid ask, put, call are separate, but I look at that. And then what I look at what the next month's volatility is. So if this month's volatility shows 30 and the next month shows only 25, then I know there is premium to be sold. That's how I look at it. A simple way, there are complicated ways of doing things, I'm sure. But I just look at the front month volatility and the next month volatility and just decide on that basis whether the premium is elevated.
Okay.
That is a simple rule of thumb I have.
Now, I've got Occidental Petroleum on the screen, and there is a feature here in Thinkorswim to show the volatility.
Yes, I mean, you can look in the option chain. Just look at November. Well, November is almost over. I don't know whether they have, but I mean, do they have weekly options? Well, weekly options are not a good measure all the time, except when you are doing earnings play kind of thing, like if Occidental Petroleum or Baidu or Apple in the week they are reporting earnings, you will see that the implied volatility for that week is very high. So
Okay.
in
Yeah, I think they
general,
already had their
but,
earnings.
if you were going to sell December puts, let's say December puts on Oxy, then look at the January puts and see whether there is a difference or they're the same. So you can sort of gauge from there whether there is any reason for Oxy to be higher volatility in November, or December, and there may not be. So that's how I do it. I just look at the current front month and the next month and
So
make
based
determination.
upon the example here, I've highlighted the same strike for both months, and they're not very far off from one another.
Then I wouldn't think there is any
So you would say that means
or anything that's the same thing. So then you might want to check somewhere. If I don't have my Think or Swim platform up right now, so I wouldn't be able to say anything.
well, my question, Kumar, would be: is it telling me that the premium for this December option is a high value or a lower value? than
No,
the
if the
January?
volatility is the same, then it's fairly priced.
Okay.
That's how I look upon it.
Okay.
It's simple. If there is no, 2%, 3%, I don't really, there's got to be at least 5% difference to make. So then I might. It helps things like if I'm doing a kind of a calendar spread, and the back month volatility is low and the front month volatility is high, even by a few percent, 5-8%, then I might do a calendar spread where I will sell the front month and buy the back month.
I see.
So that kind of thing I might do.
Understood. Now maybe we can bring in Epik here.
Can I just?
Oh no, please, yeah.
I just wanted to make an observation on this pattern day trading business.
Oh, I'm sorry. Yeah, we didn't get to that point. Go ahead.
Sorry about that, because that was kind of very interesting. Not too long ago, before the Apple earnings, because Apple is one of the instruments I trade. The Apple volatility is sort of coming down, but I take advantage of the fact. Except 2 days ago it crashed, and then I was in a lot of pain. But yesterday it recovered, and I was happy and dancing on the floor. But that apart, what happened is just before the earnings, whenever they were, I just put in an iron condor for Apple. And then I suddenly, after getting into the trade, I realized, oh my God, the earnings are due in 2 days. So I closed the trade. That wasn't much of a loss, which was okay. But my brokerage held me accountable for the fact, because it was an iron condor, 4 legs. So effectively, I closed, though they were individually, and it was one trade, 2 spreads. But from their point of view, or from the CBOE or FINRA point of view, they were 4 individual trades. So in one trade, I got docked as a pattern day trader because I opened and closed 4 trades the same day.
Right.
So it was a wake-up call. I should have known, but it's long. I don't do day trading in equity, so I'd forgotten about it.
Okay.
But that was not the worst part of it. The bad part of it is, given that Apple trades at a 600 call at one contract is worth $60,000. So if you are doing 5 contracts, you are on a hook for at least 25% of $300,000. So if you don't have that kind of money, you get into a margin call.
Right.
And the margin call cannot be met, if you want your account to be in good standing, by liquidating the securities that you already own. You have to get the money from outside to take care of the margin call. Otherwise, they will restrict your account.
Well,
so you can't do anything.
Kumar, let me ask you something. You're talking about a condor?
Yeah, it was iron condor. Basically a call spread and a put spread.
All right. But aren't they covering one another so that your margin requirements would not be there?
PDT doesn't look at it that way. And FINRA doesn't either. They are, from your brokerage point of view, you are doing spread from the margin point of view. But in their definition, they are 4 trades. So that is how they look upon it. That's why, whatever Diana said was just fine. I mean, I just wanted to add on to that. So just one trade got me into trouble.
Right.
There are 4 option legs there. I opened the trade, I closed the trade the same day, and I was docked for it.
Right.
And
Because I'm looking at an example on the screen of Apple. I have an iron condor, and it's telling me my margin requirements for one condor is $500.
that's great.
But you're saying that from FINRA's standpoint, they counted that as
If you close it the same day, you can check it with Think and Swim also. Your margin requirements are fine as long as you don't close the same day. If you close the same day, that's the problem with this thing is what they say is one thing, but what the law, the floor is different. There are 4 CBOE, there are 4 trades.
right. For the day trading part, I understand that. It's this other part you said about getting a margin call.
Then I
on it.
needed that much margin for a day trade. If I've got 5 contracts of Apple at 600, that is $300,000, and half of that is a quarter of that. Let's say, roughly speaking, is $75,000. So if we didn't have enough margin, I of course liquidated it. Then they constituted liquidation call, but the net result was I still, on balance, owed some money. I didn't owe any money, but from how they calculated the margin and all those things, fine. The accountants in the back room have different calculation.
Right.
As they do. You and I would do on the back of the envelope kind of calculation.
Yeah.
But the accountants do precise calculation. So when the trade was closed, they said, okay, you did so much, so much, so much. You are $1,000 short.
I gotcha.
Now go get us $1,000.
Meanwhile, 2 days later, the $1,000 is in there.
Now, you have to get us $1,000 to meet this call.
Okay.
So I just wanted to say there are, those are kind of things one needs to, and
Little nuances.
Stock like Apple, you really need to understand that it is not, as you said, that $500 margin requirement for a spread is great.
Right.
If you do one spread or you do 2 spread, it doesn't matter because you don't do it twice. You can sell an Apple strangle. Margin doesn't get counted twice. Margin only gets counted once. But on a day trading issue, there are 4 trades, and people shouldn't think that they just did 1 trade. Those are 4 trades.
Right. Well, since the show is about the pattern day trading rule, I think we definitely need to highlight that point, and that is when you're doing. If you're doing a stock itself, obviously buying 100 shares and then selling 100 shares later that day, that's a day trade. If you're buying a single call and selling that same call before the end of day, that's a single day trade.
Yeah.
But if you buy a spread and then you close that spread by the end of the day, you're technically buying a call and selling a call to open a position, and then you're selling that first call and buying the second call to close the position, and by the end of the day, that counts as two day trades.
They're both opening. The moment you do a spread, buy to open, typically a spread is buy to open and sell to open.
Right.
Anytime you open a position, 2 opening positions, that's 2 trades in an option.
Yes.
From FINRA's point of view, and that's how they deal with it. I mean, that's the law.
And in Dila's example, she was mentioning about how she sometimes legs into a spread, and that's another way of doing it. But that would still, if she closed that position before the day was over, whether she did them one at a time or both together, it might be considered 1 trade to the broker, and you'd get pay for 1 trade to the broker, but it's 2 securities that are getting triggered here, and therefore it's a day trade.
Jai opens a SPY trade, buys a SPY call in the morning when the SPY is going trending up, and midday decides that instead of closing and taking the profit, she sells a call against that. She's bought a call and now she sells a call. She has made 2 trades that day, and if she closes both by the end of the day, that's 2 trades, so she's okay. But if she does it twice, then that's 4 trades.
Okay.
Closing is okay. It's the opening transaction that matters.
Interesting.
You can close anything. There is absolutely no limit on or restriction on closing. You can close do a closing. You can close if you have equity you want to sell which you already own. There is absolutely no restriction on that. But it's the opening transactions which are restricted.
Right. Which, just for the record, that means you can actually open a position on Monday, another one on Tuesday, and a third one on Wednesday, and then Thursday close all three of them. You haven't triggered a day trade.
No, that's okay.
Yes.
That's fine. You can do 3 closing transactions on the same day. That's okay.
Right.
That's not an issue.
All right. Well, I appreciate the perspective, Kumar. Now
I thought I might just mention that along the way.
Excellent. Thank you very much for that.
Thank you for hearing me out. Okay, I'll leave it to others.
Very good. Very good.
Thanks, Kumar.
Bye.
Also, a lot of people will look at, if you want to talk about the day pattern trade.
And this is just, hang on a second, just for the listeners here. This is member Epik that is commenting. So, go ahead, Epik.
Well, basically, I called in about the vol and that put spread she did, but on trading, that's why a lot of people will trade at the close or look at the close, and they're looking for that reversal, like you see reversal candlestick, and they look to get in at the close so they can close out the next day and not get hit with a round turn.
Interesting.
That's why some people like trading at the end of the day to look for those reversals and checking for a breakout. So you buy it at the close or near close. Well, you hold it overnight and then sell it in the morning. You're not hit with the round trip.
And that must be where the imbalances are coming into play, because when they report that at the end of the day.
Well, some people use that as a signal, but I'll look at basically what the candlestick is saying. If it looks like a reversal, then sometimes I might get on it, and the market's going my way. You see the whole market turning around. Mm-hmm. Now, what Kumar was talking about was like forward volatility, where you look at the front month and you look at the at-the-money calls and puts, because that's where all the volatility is at. And you write that number down. And then you look at the next month out, and you look at the at-the-monies, and you add up those calls and puts and what that is. And then you look at the difference between those two numbers, and you say, well, look at here. A month from now, it's telling me that volatility is going down because these at-the-money options are lower than the front month.
So I have Amazon on the screen, and I've got December's and January's. Is that the right way to look at it? Ignore the weekly for now?
Yeah, I always look at quarterlies. You don't use weeklies to try and calculate your vol, because one thing, I didn't use it and I didn't trade weeklies when I was on the floor. But there's another way of doing when you're looking at the front month also, is you take when the market closes, you look at the money calls and puts, and that's the vol, and you write that number down. Okay. And then you can go back to the previous day, wherever the market closes. So, let's say, for example, you got a $15 stock. Let's say it closes at $15, and there's a $15 strike. Well, what do you think the calls are going to... Let's say the calls are worth $1. What should the puts be worth?
14.
No, they should be worth $1.
Oh, okay. Equal on the same one. All right.
Right. So right there, my volatility is 2.
Okay. Oh, you're talking about it that way.
Day,
all right.
Yeah,
all right.
That's how you calculate it, because the at the monies has all the volatility.
All right. So I have Amazon on the screen, and it's giving me implied volatility. You sound like you're not talking about implied volatility.
Well, implied vol. Let's look here. And what do they give you? They're going to probably give you 25%. See, I look at it a different way. I look at it at where's the at the money? Where's the strike here? Let me pull up my charts.
Okay.
Is this Amazon?
I've highlighted it on the screen. The puts anyway. Yeah, and Amazon.
Okay, let me pull this up. Check something. Dila, you can keep on talking.
She's answering a lot of questions in the room.
Yeah, I'm trying to read and listen at the same time. I don't know why I bother, because it never works. Nice to meet you, by the way.
Yeah, I don't know if you guys have ever spoken before or had
We
a
have
chance
not.
to.
No, I always hear. I heard it from her from somebody else.
Right.
You know, all your other boyfriends in the room.
Yeah, I have so many.
Yeah, lucky you. I've got none. I want to keep it that way. No boyfriends for me.
I think it could be arranged, though, Epik, if you'd like us to work that out.
Let me get to the D's here. Okay, Amazon closed at 233.78. So your at the monies would be, let's see here. That's like right between strikes. So okay.
So do you have to adjust it by the couple of dollars? Or in this case, maybe $1?
So the 235s is the at the money strike. Let me get them side by side now. Because you're looking at the money straddles and you're looking at that ball.
Okay.
So 235s. So like for here I have the close was at on the 235s 665. And when you're looking at options and you want to look for volatility or stocks, you look for stocks with high betas. Anything above 1. That means there'll be some premium in them.
Okay.
So you add up the calls and puts, and that comes out to what 1450 is the straddle. And then like tomorrow when the market closes, or you look at the previous day, because I don't have the options for where they closed yesterday, you look at the monies there and you compare the two. Or you do what Kumar said, is you could look at the forwarded volatilities.
Okay.
And that's a simple way to do it. Like when I was on the floor, we didn't have these computers to say, oh, I'm at 25 vol or I'm at 24 vol. I would just look at the monies and price it out there from where like it opened and where's it trading now. Mm-hmm. And you got to make sure you're on the right strike for your at the monies. You know, so when the market moves, your at the money strike is also moving too, most likely.
All right, so let me just look at yesterday's. If you could just bear with me here. I'm going to look up yesterday's. If I close out some windows here. And let me see where my date is. I think my Skype is closing it. All right, that would be the 19th. So you would look at the 235s?
Where did it close out at?
It closed at 229.71.
229.71. You'd have to go and look at yesterday's settlements for the options and look at the 230 strike.
All right, so you stick with the 230s. So, and we're looking just at the asks?
Well, I just take settles.
And what do you mean by that when you say you take the settles?
Whatever it closed at, whatever it marked out at.
I mean the option. You take the ask of the option.
I don't know what you're saying by ask by the option.
All right, I'm looking at the bid and ask on the option.
229.71. Therefore, the at the money strike would be the 230s.
230s.
Right.
And then the numbers I'm adding together is on which side? The bid or the ask side?
Don't they give you a settle?
Oh, not with this platform.
Oh, really?
I guess I can get a mark price and it'll give me a the in-between price. Let's take that. I'll take the mark price. So I've got 1477.
1477?
Yeah.
What happened with Amazon today? It went up. So that's what I would expect. The market went up and vol came in.
And in the 235s from today
is at 1450, so volatility's coming in. So as Amazon's going up, the volatility's coming in.
Meaning that it's reducing?
Yes, meaning that your options are getting actually cheaper.
As the price is going up?
Yes.
Now, why would that work?
Because they're squeezing the volatility out of the puts. And they're squeezing it and the volatility out of the calls. You notice how when we look at the VIX, when is VIX at the lowest? When the market has been trading higher. When's the VIX at the highest? When the market is plunging. And that's what's happening here. As Amazon's been trading higher, the volatility has been coming in. So basically, the options are getting cheaper to buy as it's going up.
Uh-huh.
So you don't want to be a seller of the calls because you're actually losing vol. They're actually on the cheap. So basically, maybe as Amazon's going up, people are getting nervous and they're selling the upside calls because that's the most traded option strategy there is. That's the biggest option strategy is selling of calls.
Now, is there
of calls, buying of calls as speculators, and there's not that many speculators in the option market. The options, and especially in the calls and stocks, are used to protect long positions.
right? That's what they were created for.
Right. Or for hedging.
That too.
What they don't allow you in options trading or like the brokers is technically if I'm selling a 50 delta call and I have 100 shares, I should be able to sell 2 of those calls instead of 1.
Right. I know what you're saying.
Right. When you're doing the covered called strategy, they only allow you to sell, 1 for 1 and not use the delta. Because I would like to go out to like a 25 delta call and sell 4 of those.
Right.
And
Would it depend on your broker?
And as the market trades higher, I just start selling the
Peel them
stock.
off, right?
Yeah, that's what I used to do on the floor. Is always be hedging.
So let me ask you this now: is there a way other than this manual method that we just went through to be able to tell that the volatility is reducing?
Right, that's how you can do it. Like if you were just standing there by yourself and you didn't have any of these means or all this, where they give it to you, you can do it this way.
Okay.
Keep it simple, stupid. Just add the at the monies. That gives you what the at the money straddle is, and the at the money straddle contains all the volatility in it. So that's your vol.
Okay.
And then as it moves, you can keep on recalculating, or this is what it. Like sometimes when I was in the Eurodollar options pit, I would see where I had them marked out the previous day, and then by the midday, I could see that the futures have moved. And then I would just go, okay, on my sheets, because we didn't have computers to do this all. We had to write it down, do it in our heads and stuff like that. At the end of the day, we had the computers do it. Mm-hmm. But that's how I would do to change my volatility. Knowing, okay, as we're going up, I'm losing, like here in Amazon, I lost basically 25 cents. So I that all my calls and puts are coming in, about $12 as we go up.
Mm. Now, the platform is giving me implied volatility.
Yeah.
How do I use that versus the volatility that we just calculated?
And you look at historical vol. So basically, I'm giving you an implied volatility because it's implied off these calls and puts.
Okay.
Right? And then I use historical vol. Well, let's go back 7 days. Where was it then? And then that's what you do in volatility trading. Like the guys will look at cash vol and they'll look at historical vol. The banks have all these computers. You just go type in or whatever. They'll show you where 7 day vol was at historical volatilities. So you're looking at 7 day, 2 week, 21, 1 month, 2 month, 3 month, 6 month, and so forth. I mean, for like me, you'd have to be logging in every single day, have your spreadsheet or access or something, or do it in a spreadsheet and just keep track of it every single day.
Right.
It's like somebody who's jumping around from stock to stock to stock, and they quickly need to figure out, well, where's vol at? Where do they have their stuff valued at? You look at the monies and calculate it and look at the at the money straddle and say, okay, I see where they have this. And let's say, remember I was telling you about that $15 strike, that hypothetical XYZ company. Well, let's say it's at 15.10. Right? Well, I know the calls and puts were worth 1. Well, what do I think it's worth now? Well, those calls might be worth at least 110. But knowing that as the market goes up, vol comes in. Well, now those puts for the 15 are probably 90 cents, and that would make this the $15 call is probably is like still $1 or 101.
Interesting. I see what you're saying.
Vol's coming in. I have to put, because the puts right now, they're out of the money. And the volatility is telling me 90 cents against these at the $15 strike of this XYZ company. Well, there's got to be at least 10 cents of value in that plus the 90, which leaves it $1.
Right.
And maybe $1.01, maybe there's like it wouldn't be $1.01, but that's where theoretically it should be trading at. And that's when I'm trading stock or looking at options, I'm also looking at that. I'm looking at the prices where they have it to know whether or not they're overvalued. Like if I'm chasing it and saying, well, I'm chasing it, look at how they're all bid up, and what's that value? Is it over or undervalued? And then I got to look at, your stochastic, because when I trade options, I like looking at the 15-minute stochastic crossover, and I'm looking at the Bollinger Bands on the 15-minute.
So on Thinkorswim,
people think it's easy to come in there and just say, oh, I'm going to buy some calls and watch it go up. Or Johnny says the stock's going to go up. I'm going to look at the money calls. Well, you know what? You never want to buy at the money, and you don't want to buy out of the money. When you buy calls for speculation, you should buy them in the money. You want to rent that stock. Granted, that $15 stock, XYZ, I can buy those calls for $1, right?
Right.
So it costs me, $100 to own one call instead of owning the stock at $15. Well, if I look at it deep in the money, let's say the $12 would be worth $3.
Right. So it's more out of pocket, but its movement will be better.
1,500. That's what gives you the leverage. Plus, when you're buying those deep in the monies, you're not buying the volatility.
Because it starts to flatten out?
Well, yeah, because all you're going to be buying is the time value, which is most really, really small if you're dealing under 90 days.
Okay.
You know what I'm saying? Because all you're perfect buying is just the opportunity to rent the stock to be long.
Right. Yeah, I've heard that referenced that way before, where you're just renting the stock. I like that.
Own it when you can rent it.
Right. So I have GLD on the screen, and the platform does give me the historic volatility.
Okay. I mean, then use that to your advantage. So when you're buying it, and you can say, okay, historically, this stock, or what is this, GLD, where's the historical?
On the left side. I don't know if I can highlight it. No, I can't click on it. But do you see it's the historical is 26, the high.
Okay, 26 the high. But what is it like?
Currently, it says 29%.
Currently, it's at 29%.
And the current implied is 1%. Percentile? Is that talking about the same thing?
Well, I don't really use that platform. I just do this. I do the options.
Okay.
So, like, if I was going to use this, and they were giving me the implied volatilities, and they give me historicals, well, I'd have to look at this option and see how closely I can get the historicals. So if there's 30 days left on this option, and I could look up and say, what's the historical value for 30 days, and see how they compare. Well,
correct me if I'm wrong. The historical volatility, is that a different number for each strike? And each option? Or is it one number for the whole stock?
Well, the volatility is always going to be at the monies, and that's where it's calculated at.
Okay.
Now, when you go up or down on the strikes, then skew may be added in.
Okay, right.
And all that is also, as you go up, it's the probability of it being in the money.
So let's look at this example now. You have December. I would assume you're talking 167s then, since it closed at 167.39.
Right. That would be the at the money.
And so the strangle on that would be, let me change this back to the mark, 216 and 260, so 478, let's call it. And then if we go back to yesterday, when it was trading at 167.87, would you consider that a 168 rounded up?
We're looking at the 67s?
Today we are, but
Yeah.
as of yesterday, the close was 167.87 cents. So do you round that up to the next strike, or you stick with the 167s?
What was the penny on it? I didn't. They dollar strikes on here, so
Yeah, the penny's 87 yesterday.
cents. If it's 70, if it's 7.5, so then you could go to either one. But if it's 1 cent higher over 50, then you go to the 168 strike.
Okay, so then that mark is 497. So we go from 497 yesterday to 478 today.
Right, and gold went up, and volatility came in.
GLD went down.
And volatility came in.
Yeah.
So then you got to see what's going on here. Options are getting cheaper as gold's going down. Is that what they want? Is that what people were looking forward to?
Well, there is this overhanging pressure about the fact that demand is not there, and
So it's expected. When you see stuff like that it's expected. When volatility goes up, it's most likely unexpected.
okay. And that's how I've looked at it from a fundamental standpoint. That volatility is the unknown.
As going down, there is no fear in the gold market, so it's expected, or there's room for some downside in the gold market.
Yeah. Interesting. Well, I appreciate the perspective, Epik.
Guys are always talking about options. It's not like the way I look at it, and I don't know if it's the right way, but I mean, I've used it a lot. So
Yeah. Well, it gets back to some of the things we said in the beginning, which is that there are so many different facets to options, but you've probably have been trading when options were gaining popularity, I'm assuming.
well, 95 is when I was on the floor with Swiss Bank doing it.
Okay, so I guess they've been around for a little while.
Well, options been around since 90 or 74.
Okay.
BO started trading it. I think they started out with calls, and then they started trading a lot of the options, because at European options traded at the Philex. European options, the ones that we trade that most of you guys are used to, are called American options.
Mm-hmm.
There you can get early exercised.
Which somebody mentioned in the room.
Yeah. So, like, a lot of times, if, like, banks are looking at, okay,
Whenever you type, it's shutting down the Skype a little bit.
who is?
On your end, it's like getting choppy.
Just because I got stuff going on in the market.
Oh, you know what, you guys? That's probably me. I'm sorry. I thought I was muted.
Oh, you're typing. Oh, okay.
Yeah,
so
sorry.
it's picking that up then. Okay.
Yeah, I'll stop.
So, like, what banks do, I mean, they're always hedging or looking for arbitrage opportunities. Now that's computers, but when I did it, you know, we had all these
Oh,
screens,
thank you.
24 little 13-inch screen monitors looking at different markets. So, like, I look at what's trading at the Philex and look at what's trading at the U.S. or right here trading U.S. options. And what you'd look for is to look for the same. All of it's the same, except there's one thing. There's always a little bit more premium in the U.S. option because there you have that right to early exercise. And a lot of times you go, well, I don't think I'm going to get early exercise or something. You'll squeeze that out of the option. So you sell U.S. and buy the PhilX exchange because it's got that little extra value. Same thing like in the floor when I'd be looking at the cash market options and looking at the futures options, and when they lined up saying, okay, they're all expiring on the same day, well then their prices should be the same, and if not, that's when you had the arbitrage and be like, wait a minute, the cash market's trading 2 ticks below the future, so I sell the future options and buy the cash options, and done.
Interesting.
Like 7 days left in the quarter before it settles out. We would do stuff like that and do the arbitrage and squeeze that market.
Now, how often would that happen in a year, let's say?
Well, when I was on the floor, it used to happen quite a bit, and then it all of a sudden was every quarter, and then it just kept on, or it's still there, but then it wasn't worth it. It's like, well, I'm used to doing millions or hundreds or thousands, and now it's only like a 50 lot. You're like, forget about it. I don't get caught on a leg and stuff like that. But if it was immediate and there was plenty of shares to do, then you did it. But if it was like only like a 10 lot, you'd be like, oh, let somebody else, because you get caught on a leg. Buy, sell. Well, wait a minute, where was it at? It was there, and now it's not. I want to hang you. Well, telling them you're hung. Saying, showed me the bid, and I needed it, and it's gone. All of a sudden, it gets pulled, and I didn't get it. So, like that would happen on the floor.
So you're talking about physically getting 2 different pits' attention to execute that trade?
Well, yeah, or on the screen, you'd have one guy on the phone. If I was up in the office, I'd have 2 guys on. I'd have a phone in each ear.
Right.
Going, okay, buy this, sell that, done. What do you mean it's not done? Oh, it's off.
Oh man, that's
slamming the phone down. And
yeah, that's when the phones could handle that, right?
Yeah, they could.
That's the one thing you can't do anymore. You can't slam a cell phone down.
In the day, they were pretty sturdy.
Yeah. I still have one around here somewhere.
But yeah, I would have like 32 lines and be calling all over.
Yeah.
And then, or you do arbitrage and so forth, where you trade synthetics. Whereas, like, if you bought 2 calls, that would be like long one future if you did it at the money, and that's how I use delta. Some people look at it. Oh, the delta is 50, so if it moves up $1, it theoretically should go up 50 cents. I go, screw that. I don't use it like that. I always use my deltas as a way of hedging. Because that's just theory, and the money thing is totally different, because as it moves up, it might be losing or gaining value. So when I'm looking at stuff and I want to do a spec position, I usually rent the stock and I do it. But sometimes if I'm looking for like black swan events or something, then I'm looking at 30 delta or 25 delta. And that's a spec, and that's something that you got to realize that might not get taken out and might not be in the money. That's what people think. Like, oh, I want to get long cheap. And so they buy these out of the money calls, and that's the wrong strategy. The better strategy is to buy the deep in the money call and not pay for any time value. Right? And you're just renting the stock. That's the way you should look at your options trading.
Well, you sound like a purist when you put it that way.
Well, I see some people going, oh, I'm buying these calls are way out of the money, and I'm like, do you really think they're going to get there? I wish you were there on the floor so I could have sold them to you, and
Yeah, me too.
You know,
I've been preaching the same thing during the options classes on Wednesdays. Buy in the money, people.
yeah, you got to tell them that you're running the stock, and it sounds better that you're long. Because I mean, like, I have a few guys who called me up and said, "Hey, you know, I've had problems with my accounts, and I get them out of trouble by just using covered call strategies." Or there's even collars. I go, I mean, yeah, you buy the stock and you sell the upside call, and I go, you know, you just locked in $200 and it gives you $200 of downside risk or something, but you could take that $200.
No, upside down. Like this.
That's what I said. This way up.
25 cents, and it doesn't. So,
All right. You might hear me cutting in and out on you, and that's because I'm trying to adjust some of the settings here. For whatever reason, I have your voice has been cutting in and out during the call, and I don't know exactly why that's been happening.
And it's against me. So,
Well, now I understand your avatar.
which one do I have up? Woody Woodpecker? That avatar?
No, the looks like the pit somewhere.
Yeah, I keep on changing it. I don't know if that's with two guys or one that looks like me or just the whole floor.
It's like the 4 or 5 guys.
4 or 5 guys?
Well, it's a group. You know, it closed in on 2 people
On the screen's
holding up pads. Anyway, as the market's breaking down here a little bit, down to 85.25. I saw some people asking earlier about this spike here, and I wasn't really able to do any research while we were talking. But did you happen to notice what made this spike happen around? Was that 8 o'clock or so, or 7 o'clock Eastern?
Well, you know, when I was looking at price, 1889, I know that's one standard deviation away from the mean. So I was looking for that price all day today, trying to get that stuff there. And of course, you know,
Happens the next day, right?
I don't have any position on it. So,
and some of the traders are saying this is the only security that did this spike. I don't know what else.
it touched it went up to the up to one standard deviation from the previous day's close.
And it just broke through the low of this period anyway. Which was back on 85, just broke 85.
I've been scribbling. I had, let's see. So a half a standard deviation from the mean on the ES would be like 1379.9. So 1380. And then a one standard deviation move would have been, it's going to be 1373.60. So that's what I'm looking for. So if I want to do a collar or like do a be long a strangle, I'd be looking to buy it at 1373 and sell it at, if I want to go a whole standard deviation out, to 1399, which is a far cry, but you can do that with options.
Yeah, I was just about to say, you're talking about options. Let me see. Do options, futures options trade all the time?
No, they only trade during the pit hours, I believe.
Okay.
But like you talk about these people doing boxes and credit spreads and all that. The biggest problem about doing those is, like you said, I mean, there's like 4 legs to it, two to a spread. I mean, your commissions, if you don't have low commissions, you're just going to start raking it, you know. The brokers love it. I go to these like classes and things like that, or you go to an investment thing by some broker, and they talk about doing the credit spread and say, hey, look at here, you're taking in this credit. Yeah, but you're making all this brokerage off me.
You're not supposed to notice that.
Yeah. And so when people talk about boxes, condors, and stuff like that, I go, keep it simple, stupid. Don't deal with that stuff, because if you don't have the best brokerage, you're going to get, squeezed for what it's worth. And like what you see here, it's like, oh my God, you got to leg it, you got to do this and that. It takes time, and you're going to have a lot of slippage. So just like doing covered calls and collars, those are probably the best things. Learn those, and then maybe later on, if you want to dabble in that stuff, go to that. But I have a problem when I'm trading futures and then I want to do options. It's not like I can go to the screen and click on options for futures. You got to call somebody. That's the biggest problem I have, because I'd rather be trading, corn options and options on the grains than trading the underlying, the future. But I have to call down their brokerage, and they charge you, so much more, because you have to make the phone call down to the floor, get a market, and maybe trade it.
Well, some of the platforms have the options on there.
Really, on the futures?
Yeah, I have it on the screen now.
Oh,
well, this is on the ES, but obviously you could do the SPX futures.
Right. See, I need to use my Thinkorswim platform more. To me, there's just like so much stuff. It just
you have to tune in to Tools of the Trade. That's what we're here for. We're covering all these things. I got to give a plug for the show.
Too much for me. I'm too old, I think, now. I like doing it on a piece of paper and writing it out.
Well, hey, listen. I've done a couple of shows. One in particular was when I talked about single monitor trading. And we went through a bunch of photos from some members that had been submitted and showed how their setups look like. And one thing I always highlighted is the importance of having a notepad in front of you. I agree with you. I don't think it's a good idea to strictly rely on the software.
Yeah.
I don't think you can really fully grasp what's happening until you start writing it down. That's why I was doing the notepad thing earlier with Dilafng. Was to keep it straight in my head as we were talking about it.
Yes, I'm always writing stuff down, or you'd be like, oh, you just write the letter and you get back to it later when you have time and say, oh, I gotta check that out.
Mm-hmm.
Excuse me, boss. You have a text message.
I think this is just something like, oh, I lost my job, I can come and do this.
Right. Yeah, not a good. Now you're trading on the edge of the.
Everybody jumping in on the bandwagon on 2007. You could see them. You saw all these sheep come to the trough, and they got slaughtered.
Mm-hmm.
They have this bitter taste in their mouth about trading or whatever group, whether it be like Day Trading Radio or Mr. Tops Up or whoever, and they came in paired. I tell these young guys, I go, it took me a really long time. One thing because I'm stupid and got a thick skull, but you have to see all the business cycles.
Right.
So a good trader, yeah, you might pick it up in 3 to 6 months, but you haven't seen the worst and you haven't seen the best yet. When you get like 5, 10, 20 years into it and you see all the up and downs and you realize like, oh my God, that's why they say don't fight the Fed. And it's the truth, it's just crazy how it works. Like me now, it's like second nature. Mm-hmm. It's sometimes I see something like, oh, that's going up, or sometimes like I'll dump it thinking it's going to go lower, and I'm like, why are you doing that? That's a flag. It's going up. Why did you get out? And I missed my spot or something like that. Things like that. You see it all the time. I saw it today, and I said we're going to trade up. Still looking for that 89, but I sold my longs at like 80 something, 83. I forget. I got to go look and look at all my trades still because I'm here. That's what I hate about the night shows. I don't watch it. Look I dumped out my futures and it popped. That's what I hate about the night.
When did you dump it? Not because I brought it up, I hope.
No, well, I wasn't paying attention to it, and so I'm like, well, I might as well just get out.
Well, it is popping and going right back up to the 200 period there, which also the 150 is converging, and the high of yesterday, which was 87 quarter or 87.5.
Because look at how fast the stochastics went on the 1 minute and 5 minute, but look at the 930. I tell this one like in some of my other trader spotlights with RPM. With it's 9:30. You want to look at your 30-minute chart and see if that's turning too, and that's why I got the big push up, because now the hourly, everything's all lined up, and that's why we got the pop. And let's see if it like bull flags, and you'll get another leg up and try and test out that high at 1389 that I've been waiting for, for 2 days now. It seems like, well, a day and a half.
I have the other time periods, but the graphs are a little differently looking. Now the 60 looks like it wants to sell off.
No, it could be getting embedded. So when you see that, when you look at the 60, don't say, oh, it wants to sell off. Why don't you say, oh, it looks kind of strong? And look at the MACD. MACD looks like it wants to turn higher. See, I wouldn't say that this hourly is weak until it goes below that like 80 mark, and it's at 87. So that means we still got a whole nother 30 minutes of waiting to see where this is going to mark out at to start a new hourly period. That's the whole thing about a trader. A trader is a waiter.
I like that.
Yeah, it's great. What do you do? Well, I'm a waiter and I'm a trader. So, it just touched it. That's one thing, you got to know your spots and technicals. That's the hardest thing about the transition from being on the floor to trading on the computer, is that the levels really, really play out now. It's like that whole 1389. We went up there, touched it. Now here, look at that, like 200 period.
Well, we also touched it a couple other times too.
Yeah, but look at how it just goes straight for that spot and comes back off of it. Do you understand what I'm saying? How it just raced up there? Why didn't it stop at the 50? No, it went straight up to the 2. Once it broke the 50, people are like, oh my God. It was like me. It's nighttime. You didn't think you'd get a move like that, and people are like rushing in to cover their short. Mm-hmm. Saying, oh God, I got short up here. Now I'm just getting flat. And they wrote it down for whatever it was, an hour. And what did they have show for it? Nothing.
Mm-hmm.
Because they were listening to the show.
Yeah, and these are the volume peaks right here too, at this low and at this little pivot area.
Right. So, Dilafng, you're supposed to be talking, not me. This is your show, so I better go. I gave my 2 cents, so.
No, this is Briguy's show. I'm just visiting.
Epik, I feel like you gave 4 cents. I appreciate it.
Oh, I appreciate all the people who came out to Las Vegas this year. I had a really good time talking with the members and Les and so many. I can't even remember all their names. I wish I'd spent more time with Johnny. Look at this. Now they rip them up and they sell them to you. Rips and then the rips.
It's like they saw them coming.
See? And look at this. We're making new lows. And it's crazy. Is there any news in Japan?
That's a thought.
Are they all on holiday because of Thanksgiving here in the U.S.? It could be also that, too.
I think I'm picking up on the fact that my mic has been causing you to be choppy a little bit. So that's why you hear it get quiet for a second. I'm just muting my mic as I
Oh no, that's all right because I'm sure I'm always choppy because you're living out here in the sticks in Texas and you don't have the best internet service and as much like I got all the markets up and so when that goes on, I'm sure my Skype is choppy. I always blame it on me. It's my fault.
All right. Well, the Nikkei is up a percentage. It does show them to be open, and Hong Kong's up a half a percentage. And somebody's saying in the room there that there is some news crossing, but apparently they're keeping it to themselves. No decision made. Will continue talks Monday. That sounds like the U.S. news. Questions about the international news.
Hey Trey, I'm in Weatherford. Where are you at? I'm just reading what's going on.
Yeah. Somebody's mentioned the French real estate. I don't know if that's recent or that's just an overall.
I think who did he? Oh, he's in Grand Prairie. There's somebody in Evanston too. You know, there's going to be no Trader Expo in Dallas because of low showing last year, and I was thinking maybe since there's going to be no Traders Expo in June that we could have a meet and greet maybe at Starbucks or something like in Arlington. So I know there's some other things going on in Dallas though in May. Some technical analysis things supposed to be going on, and I'm going to get more information on that.
I think we should have a meetup in Los Angeles. Everybody can come here.
I wonder why she's voting for LA.
Because the weather is perfect.
I was just there last October. I was in Manhattan Beach, and
there you go.
You missed the opportunity. But yeah.
Well, I think it's past my dinner time, gentlemen. So I'm gonna sign off now. But
Thank you.
Thank you both for your time and for Briguy for having me on.
Thank you.
Briguy must be on mute.
Yeah.
Am I talking to myself again?
Yeah, were you talking to yourself?
I think I was. I was just thanking you for coming on.
Oh, you're welcome. My pleasure.
And perhaps we'll meet up again in the future.
Yeah.
And Epik, thank you for coming on as well. And
Thank you.
for your commentary. And also to Kumar, thanks for calling in earlier and bringing out those interesting viewpoints. So I'll say goodbye to you guys as the market's dropping off here.
Yeah, and
Thank you and good night, everyone.
So I just put the crickets on. I don't usually have them on overnight, but it was actually the popcorn was actually sounding there once or twice. I don't know if you heard that. And just to clarify what someone had posted earlier about the no decision, it definitely is regarding Europe. And I do see that link here from Zero Hedge anyway. Maybe this is elsewhere as well. Frieden says Euro finance chiefs to continue talks on Monday. So no decision made. And I'm assuming this is regarding Greece, or is this France, or is this Spain, or is this Bulgaria? Not sure which. I haven't been following it close enough to know who Frieden is. Anyone? But thanks for all our callers here, and I think we had a nice time talking about the pattern day trading rule. And I don't know if Dyla had more examples to give than the two that we discussed. And I don't know if it's enough to cover on another show. Maybe we'll do that. Or we'll just add some comments to the post. We'll put the video up in the member room and consider adding some comments there. But one of the things I wanted to mention is regarding how things are treated by individual brokers. So with my broker, they did confirm that as long as you have a cash account and it's not labeled for margin, then you can then you're not subject to the pattern day trading rule. So I don't know, maybe that was another example that Dyla was going to give. I didn't want to forget to mention that. Perhaps when you opened up your account, you might have selected the choices to get a margin account. Now here's what happens. If you have a margin account, and let's say you have $5,000 in the account, and you put $4,000 into a trade, and then you sell the same day. Okay, that's a day trade. But here's the other thing. When you sold it, that $4,000 that you put back in the account, let's say it's $4,200 that you put back in the account, you can now use that $4,200 to get into a second trade with a margin account. And now you've got your $4,200 plus your $1,000. Now you have $5,200 to use in another trade. However, if you have a cash account, then once you put that $4,000 into a trade and then you sell it and now you bring back in $4,200 into your account, you cannot use that $4,200 to enter a second trade. You have to wait for it to settle. And as we mentioned earlier, if it's an option, then it needs to go to the next day, the next business day. It will settle, and then you can trade the next day. Different rules for stocks. That's a 3-day rule. So that's another aspect about the difference between a margin and an option. A lot of people think about margins as strictly being the leverage, the 2-to-1, the 4-to-1. Some prop traders offer 30-to-1. But it's not just that. It's when it comes to options, actually, when it comes to options, you don't even get to margin that. So if you have $5,000 in your account, you can only trade $5,000 in options. And no more. So from that standpoint, it's strictly speaking a cash account anyway. And if that's all you're trading and you want to be able to get in and out of positions, then you can consider doing it that way. So I'm going to wrap up the show. I wanted to mention briefly that the DTR Relief Fund, I have the let me get the home page here. If you go to the home page, daytradingradio.com, and you scroll down on the right side, you'll see somewhere above the HPS highlight is the DTR Member Relief Fund. And we've had a couple more contributions come in since the last time we talked about this. And you guys are really awesome in doing this. We're up to $708 now. And I've reached out to some of the members, and it seems like everyone's, bumps and bruises and some things, but not enough for them to say that for sure that they feel the need to accept any of the contributions, but they'd like to see it go to some other areas. So I am kind of looking to you guys for your comments. If you can go to the member forum where this is posted, and I'll show you. If you just go to one of the advertisements, one of the announcements that were given, for example, here's the one about Twitter. If you scroll down to the section underneath, support the DTR Relief Fund, you click on that and it will take you to this member forum page where I posted the information about the making the contributions. Here's the link to the donation page, and then there's some updates that I've given where I've mentioned the latest thing I mentioned was this Long Beach, New York relief fund that was set up, and one of the members lives in that area, and he knows that that area is hurting. So I'm not saying that we'd send all the money to one place, but that's certainly a consideration. And then, of course, I'm thinking, and this is just me, but I'd like to get your opinion, is Staten Island. Perhaps we look in that direction. And I know one of the members had sent me an email, or I should say a Twitter, about the things that were being done out in Staten Island. And at this point, I think, this is, again, my opinion. If you guys feel otherwise, then you can post your comments. But I think it's better for us to take the money and give the money rather than go out and purchase clothing or supplies or tools. And I've always found when it comes to agencies that they feel, unless you live there and you're bringing something to them specifically, that's one thing. But if you're distant and you're sending things in, it's a lot easier for them to manipulate cash itself and leverage that with their connections than it would be for us to arrange to go purchase some random tools and then figure out a way to ship the tools to them. So that's my pitch there. So thanks for those that have contributed. Thanks to those that have given suggestions on what to do with the contributions, and we'll see how that works out, and check in after the holidays here this holiday week and start to firm up a distribution on this, at least a start at the distribution. So thanks for tuning in to Tools of the Trade. We got the market pulling back now down to 83.50. You heard some of the levels that Epik was talking about earlier, and that's just an example of the types of things that you can get from the members as if you do sign up for the membership here at daytradingradio.com. We do have separate chat rooms. They are membership chat rooms. They're not public. They're controlled by Day Trading Radio. RPM has done a fantastic job in setting them up, and they're there for the members. So you can set up any room you want. If you wanted to go off and get 3 or 4 traders to go in a room and start talking strictly about gold, let's say, then you could set up a room to do that. But for now, we have these rooms that are focusing on options, futures, forex. There's the trading only room where we're just putting our opening positions or closing positions or targets per se. And so there's that room. There's also members that have opened up the Apple Scalpers room where they're just strictly trading Apple and between the stock and between the options, a lot of times the weeklies. And I know those guys are doing a bang-up job there. So and we see this pivot line actually came into play here at 82.40. It's labeled at 42. I know that's not the actual number. It was called 82.50. And one of these days I'm going to get this standardized for the show because the way I like to use it on my own. Yeah, we did actually come down and touch that 82.50. Sometimes I like to bring up the sales and see what's actually coming across. See if we had any big lots come through. Look at this 235 lot come through at 83. So stochastics lining up. So good night of trading. Thanks for all the members in the room for checking in, and those of you out there who are not members, thank you too also for checking in. And in the future, you might be somebody who's checking out this show at a later time. Today, I should have said at the beginning, but today is November 20th, 2012. Daytradingradio.com. What I'm going to do is stop the video, and then I'll log back in. I'll throw some tunes on. If you have any song requests, you can get them to me now. Otherwise, I'm just going to put the radio on and let it run some random tunes. If you give me some suggestions, then they'll be factored into the videos. Always a place to vent. We appreciate you guys calling in and venting along with us. And check out the show tomorrow, 8 a.m. Johnny will be back in the chair and rocking and rolling with some setups. He's already given out a few near the end of the day, and that'll continue tomorrow. So that's it for Briguy's Tools of the Trade. I'll see you guys next week, where actually I should tell you, coming attractions, we're looking to have on I believe Speed Trader Craig is due to be on the 27th. If he's listening, I was supposed to send him an email last weekend and I didn't get to it, but he's on, whether he likes it or not. We're going to drag him onto the show. So, see you guys in the trading room, and see you guys on the show next week. Good night.